Good morning. I'm Brad Smith alongside Julie Hyman. This is Yahoo Finance Live. Let's get right to the three things that you need to know to start off your morning. First thing you need to know, a lifeline for Credit Suisse. The embattled lender has tapped a loan from the Swiss National Bank, borrowing an equivalent of $54 billion to halt liquidity concerns. Shares of Credit Suisse rallied on the news after hitting a record low yesterday after its Saudi investor ruled out further assistance. The Swiss Central Bank also offered to buy back around $3 billion worth of debt from Credit Suisse. Second thing you need to know, the SVB fallout continues to have ripple effects across the financial sector. Shares of First Republic Bank extending their downward spiral this morning on reports that it's now weighing a possible sale. The dramatic collapse in the mid-sized bank stocks continues to come as nervous bankers withdraw deposits and plow their money into safer options at big banks. But those larger bank stocks still taking a hit. The six biggest Wall Street firms have lost nearly $165 billion in market cap this month. And the third thing you need to know, the White House is hardening its stance on TikTok. The Biden administration reportedly demanding that TikTok owner ByteDance sell the U.S. arm of the company, or it will face a potential ban in the country, according to the Wall Street Journal. TikTok has been under U.S. scrutiny for years now over fears that China is gathering Americans' data from people using the app. TikTok says that a forced sale wouldn't fix any perceived security risks.
Credit Suisse announced that it's going to exercise its option to borrow up to $54 billion from the Swiss National Bank as it tries to regain investor confidence after its stock hit an all-time low yesterday. And in Swiss trading, initially, it was working. The stock was surging. You can see it here in U.S. trading now. It's up about 5.5%. It was up much more than that earlier in Swiss trading as well. So we're talking about 50 billion Swiss francs now that the Swiss National Bank has made available to Credit Suisse. That's about $54 billion in U.S. dollars. And obviously this is in order to reassure investors about what's going on at Credit Suisse. Basically, now Credit Suisse says it's going to buy back some of its debt. That's one of the things it's going to do to try to cut down on its interest expenses and take advantage of what are now very depressed prices of many of its bonds. So it seems like the crisis there is forestalled for now. Effectively, just like you had with SVB, we're going to talk throughout the show about some parallels and some differences between the two banks. One of the parallels is that you have a crisis of confidence.
Sure.
That's really what is at root here. If you talk to analysts at the bank, certainly if you talk to executives of the bank, that's what they've been saying is there's nothing fundamentally wrong here is what they are saying. Right. That it's a crisis of confidence.
Yeah, and in what they are saying, even within some of their statements most recently, they are saying that as a global systemically important bank, like its global peers, they're subject to high standards in capital, funding, liquidity, so forth, and leverage requirements as well. And as of the end of last year, Credit Suisse had a average liquidity coverage ratio of about 144%. You think about the stress testing that every bank on a year-in, year-out basis has to go through, whether that be conducted by, in the U.S. here, by the Federal Reserve or other international agencies. But that is essentially to ensure that in any event that banks have sufficient capital to absorb more than $600 billion in losses and that they can continue lending to households and businesses under stressful conditions. What more a stressful condition than we find ourselves in right now, as many of these banks are trying to prepare for what type of demand they would see for their products, either in loans or even just in cash withdrawals for businesses or households if we were to enter into deeper components of a recession in the near future.
Yeah, and the Credit Suisse problems are quite specific to Credit Suisse, sure, as we have been laying out. The company's undergone really years of scandals, has had to pay fines for various wrongdoing, has had turnover in its executives as well, and then recently said that it had found material weaknesses in its accounting and as a result was going to be delaying the filing of its report. So that is the more immediate stuff that led up to now the stock plunging in recent days, also after its biggest investor, Saudi investor, said it was not going to be putting more money into Credit Suisse. So that is now where we find ourselves. Credit Suisse obviously doesn't have a huge presence in the U.S. However, it does business with banks internationally, including many of those in the U.S. So that's why there's this concern if it wasn't able to, say, make good on, any kind of financial relationships it has with other banks.
Right.
That's where the concern lies.
You talk about the history of scandals, and I was just going down kind of a timeline of what some of those scandals were. I mean, you could almost set your clock on a yearly basis to some of the scandals that had taken place at Credit Suisse, whether it be the 2014 U.S. tax evasion, 2016 Italian tax evasion, 2016 U.S. anti-money laundering fines as well that they had taken on, European tax evasion in 2017. The list goes on even into the 2019 corporate espionage that was really the talk of not just Wall Street here in the U.S., but internationally, to your point. And there you're taking a look at some of those timelines of key events that have taken place, too.
So now we have to ask the question of what will happen next, right? It has the ability, it has this liquidity to tap into it, the Swiss National Bank. JP Morgan analysts out with some interesting scenarios this morning. They say we could actually still see a sale of the bank, perhaps to a UBS, possibly followed by a listing or spin-off of the Swiss bank, which is worth 10 billion Swiss francs. They said we could see the Swiss National Bank step up with more measures here to take care of it, or the company could close the investment bank. So these are the scenarios that JP Morgan is laying out as to what could happen next. But with a lot of stuff right now.
Yeah.
We don't really know.
No, this is true. Well, for someone who's going to help us give a little bit more context as to what we should and can know about this, investors, they continue to be on edge over the health of the financial sector as concerns swell about the contagion risk from SVB and Credit Suisse's troubles. Let's bring in Devin Ryan, who is the JMP Securities, a Citizens Company Director of Financial Technology Research, for a read on the broader financial market here. I mean, if there is any way that the banks right now could assuage concerns that businesses, that consumers have, what would you be looking for them to say right now, Devin?
Hey, good morning, Brad. So just to take a step back, what's happened over the past week has obviously been unsettling. Trying to follow headlines day to day here is challenging. And so investors move to the sidelines to try to figure things out. But I think banks and just financials more broadly need to, continue to be transparent around how they run their businesses and also kind of where they differ from some of these firms that are having issues. So if you look at Silicon Valley, which I don't cover, but if you look at their balance sheet, you can clearly see where the asset liability mismatch became an issue, and they effectively became liability sensitive. Most financials are actually asset sensitive, and so just even the last day or two here with interest rates coming down, that's been weighing on share prices, but that's okay because that's just more of an earnings dynamic than some broader contagion fear, in our opinion. So I think it's really being transparent and obviously highlighting the strength, the safety, soundness of the business, and that's where we want to focus as an analyst. Those are the types of companies that will come out of this in a better spot. Obviously, appreciating that we're not going back to normal in a day or two after such big steps were taken over the weekend and then the last few days here as well.
Well, and Devin, when we talk about Credit Suisse as well, I think the concern there is the counterparty risk, right? Who is on the other side of trades, et cetera, when it comes to Credit Suisse? For the companies that you cover, how much transparency do we have into that question?
Yeah, hey, Julie. So, I feel good about at least the companies that I cover. They I think manage their counterparty exposures very closely. What we're talking about, just again, for all the banks in the balance sheets, like most of these issues are not new. And so, as analysts, we've been looking at talking to clients about a lot of these types of issues in the market for the past year or even longer in some cases. And so I think companies managing risk, managing exposures are doing even more than that. And so I feel good about counterpart exposure. However, when you see CDS blowing out like it was yesterday, that does create ripples. It creates a little bit of anxiety in the market, and so people take risk off, and so that does have a little bit of a cascading effect. And so that's really yesterday to me was about interest rates really coming off. The 2-year Treasury is down over 100 basis points over the past week. That is a significant shift in terms of thinking about one big variable of earnings. And then the other piece yesterday was just, credit is now, in the forefront, credit risk of companies, but also just, the economy, arguably, getting tighter here as a result of what's happened over the past week. And that could lead to tougher economic conditions. And, financials are obviously, really in the forefront of that type of conversation. again, the companies that manage well, you have underwritten their balance sheets well, are going to take market share here and will come out. So there's going to be a lot of opportunities created, but you really need the dust to settle here before people can really, I think, have conviction in that.
Talk more about those opportunities that would be created. I mean, for some people who would think to themselves that the financial sector is untouchable as an investment right now, what would you say to that?
Yeah, well, I do think that you need to tread carefully. Again, the headlines and trying to keep up with where we are day to day here is really tough. And so, as I mentioned, people and institutional investors, that can trade the volatility are engaged, and ones that feel like there's just too much going on, move to the sidelines. If you look at just valuations heading into even the past week, financial valuations were already reflecting, I think, concern around economic slowdown and some of these other kind of bigger macro issues. And so just one data point, financials, if you look at the bank index, it's trading at about 40% of the S&P 500 multiple. It's trading at like 7 times forward earnings. Historically, it trades about 80% of the S&P 500 forward multiple. So even if you were to say that interest rates are going to come down, there could be some credit concerns, and you want to discount earnings to some degree, valuations are very low. But again, I think that you really need to kind of see how the next week or two go here and be prudent around committing capital, because I think it's going to be very volatile with swings potentially up, but also swings down. And so I think investors need to be prudent and look at the safest and soundest companies in the space.
So Devin, just quickly, what are they? What are some of your favorites that you think are the safest and soundest in this environment?
Sure. I mean, I think that as we think about kind of where the business has evolved even over the last few days, trading activity is hanging in there, right? And so I look at a Goldman Sachs. Goldman Sachs stock is traded back down to about book value, 1 times book value. And so Goldman, terrific risk managers. When you can buy it at book value, tends to work out long term. Again, near term is going to be volatile, but that's one we really like. In the mid-cap space, I would look at Stifel Financial, tickers SF. They have a very diversified business mix, so they benefit from higher interest rates. The first 100 basis points or so in lower rates really won't have that much of a negative implication. And then some of their other businesses, like trading, fixed income trading, will kick in. And so they've got a nice natural balance in their business. And then for folks that can take a little bit of a longer term perspective, some of the advisory boutiques that I cover, whether that be PJT Partners that has a great growth story, but then they also have a large restructuring business, which tends to be counter-cyclical and could pick up if the economy turns. That's one that long term I think could perform very well. Perella Weinberg is another advisory firm that has terrific long-term growth. So there is going to be companies that are negatively kind of caught up in this fear of the market, and their long-term business prospects have not changed at all. If not, some are even going to gain market share coming out of this. And so those are some of the areas we look at. There's obviously more. I think even in banks, there's going to be a lot of opportunities, but right now there's also still a lot of some of the moving parts of their models are moving pretty significantly right now.
And just a quick one about Schwab, Devin, because I know you just put out a note on that. That company in particular had seemed to draw investor scrutiny following the collapse of SVB. Was that scrutiny warranted? And do you think that's one of the ones where I know you don't have an outperform on that one. I believe you have a market perform, but I'm curious how you're thinking about it.
Yeah, Julie, it's a great question. Schwab, the stock traded down about 40% over the past week to the lows, and has since bounced off of that. I think people were getting confused around the issue there, and there's some misinformation that we were seeing in the market as well. To us, Schwab, there's no liquidity concern. The way they fund their balance sheet is from their brokerage business, and that's essentially cash that customers have in their brokerage account. Very, very different than a Silicon Valley. They do have a fair amount of fixed assets on their securities book, and so when rates move higher abruptly, that's not great for them. And so Schwab to us was really an earnings story, not a liquidity story. And when the stock was down 40%, people were kind of trying to frame it as a liquidity issue, which it really was not. And so we've been on the sidelines. Stock obviously had a nice bounce here off the low, and I look at the earnings profile and would say, there's some more dislocated stocks in the market, but Schwab's a fantastic company. I think people were getting a little bit confused around how their bank works relative to some of the traditional banks, and particularly some of the ones that were having issues over the past week.
Devin, really helpful to take a step back here, take a breath after the past few days that we've had and get some perspective. Devin Ryan, JMP Securities, a Citizens Company Director of Financial Technology Research. Appreciate it.
Thanks so much, Julie.
More bad news potentially for TikTok. The Biden administration is pushing for TikTok's Chinese owners to sell their stakes or risk a possible ban of the app in the U.S. altogether. As first reported by the Wall Street Journal, TikTok has previously pledged $1.5 billion toward a program to protect user data amid concerns surrounding security risks. We're going to continue to unravel this ongoing story later in the show.
The safety and soundness of the entire global banking system is once again a big question mark for Wall Street as Credit Suisse has unleashed a nightmare decision for the Fed as well as the ECB. You can read all about this in today's morning brief up on the Yahoo Finance homepage. For more, let's bring in the morning brief writer, Jared Blickery. Jared.
I love the introduction, morning brief writer here. So next Wednesday, it's going to be 25 basis points or nothing at all. That's pretty much what we're expecting. Although, as we've seen, anything can happen. You could imagine a scenario where if things unfold over the weekend, maybe there's a cut built into the probabilities as well. But that's not what we have right now. And yesterday we were speaking on the show with Raghu Rajan. He's a former Reserve Bank governor of India. And what he was saying is in these two choices, there is really no perfect answer. And if Powell raises rates 25 basis points, that's going to send a signal to the markets that all this credit stress, all this banking stress that we've seen, that's going to take a back seat. And potentially we're going to have tighter credit conditions and a bigger crunch later in time. Now, conversely, if Powell does nothing, if he stands pat, that could send a very powerful signal to the market that Powell doesn't want. That would be that Powell is standing pat on interest rates and that we have seen the top in the federal funds rate. In other words, the Fed is done hiking. So if the Fed does stand pat, you can expect Jay Powell next Wednesday to be talking up his game that he could increase rates in the future or decrease them based on incoming circumstances. Now, what Powell really wants is to engineer a higher unemployment rate such that inflation comes down. And this can happen in either scenario, but it can happen in two different ways. What Powell is still trying to achieve is a soft landing, but now, because of his options, it's almost guaranteed that he's going to get a hard landing. Does he raise 25 basis points? That's going to affect the economy in one way. And if he has to admit that there is a banking panic on hand, well, what does that say about the economy and also the stock market? And if we are entering a recession, guess what? That means that the stock market has probably not made its low based on historical probabilities. Just want to show you a couple charts here. This is the probability of a 50 basis point rate hike that we are seeing evolve in the market. And let's not forget, it was only a week ago that Powell was in front of Congress and interest rates were still rising. We had this banking crisis brewing, and that probably threw some fire onto that little burning ember there. But look at these probabilities, 50 basis points, 80% all the way down to zero in a matter of days. This is a market that is very undecided of what it wants to do next because things are simply unpredictable. So with that, I send it back to you guys.
Thank you so much, Jared. Appreciate it. And obviously, this is a debate that not only the Federal Reserve is having, but the ECB is having between inflation and financial stability. And guess what? The ECB has made its decision this morning, and it's going with inflation fighting. As expected, the European Central Bank raised interest rates by 50 basis points and made a lot of comments that lead you to believe that it is targeting inflation here. The central bank saying in a statement that it is focused on inflation here. Inflation is projected to remain too high for too long, the ECB says. It says it's ready to respond on price stability and financial stability. And at the same time, the central bank is refraining from signaling future interest rate moves in its statement. This 50 basis point move by the ECB was widely telegraphed. And so there was still, unlike here in the U.S., there wasn't a lot of expectation necessarily that the ECB would move on that. And it also was given some cover, of course, by the Swiss National Bank, which came in to offer a lifeline to Credit Suisse. But still, Brad, really interesting here that you've got these two central banks with very similar issues and the ECB is continuing on its inflation-fighting path.
Yeah, zeroing more on the statement from the ECB, the staff now sees inflation averaging 5.3% in 2023, 2.9% in 2024, and then 2.1% in 2025. At the same time, they're also still iterating here that the underlying price pressures remain strong. Inflation, excluding here energy and food, they continued to increase in February, and the staff expects that to average 4.6% in 2023. That is higher than foreseen in December projections there. So they're continuing to monitor some of the upward pressures from past supply shocks and the reopening of the economy fade out as tighter monetary policy increasingly dampens demand. That via the statement from the ECB this morning.
Yeah, and also a reminder, inflation broadly in the Eurozone remains higher than it does here in the United States. For more on what to expect from the Fed amid this banking crisis, we welcome in Sonia Meskin, head of U.S. Macro at BNY Mellon Investment Management. Thank you so much for being here. Obviously, a lot to consider. As I mentioned, we just heard from the ECB. They've made their decision. They raised 0.5%, right, at their meeting. How do you think the Fed is going to play this between sort of challenges on all sides?
Very, very tough situation for the Fed. Remember, rates are in absolute terms higher here in the U.S. than they are in the Eurozone. The growth is also higher. I think, it used to be that their choice was tough enough between employment and inflation. And now it's between employment, financial stability, and inflation. So it's not an easy choice. I think that, on the one hand, if we do get as a result of this, you guys mentioned before, small regional banks are still under pressure today. If what we get from this is a contraction in lending that leads to a contraction in U.S. growth, that will likely, at least to some extent, take care of the inflation problem for the Fed, but also likely at the risk of a recession. The data right now, we saw quite strong data for the CPI in February earlier this week. The data on the inflation front remains strong, but it's a question now how much of it is too backward looking. So I do think they go 25. Obviously, I think 50 basis points is not something that is seriously under consideration in this scenario. I do think they're more likely to raise rates than not, which will show that they've ring-fenced the problem on the financial stability front. But it really remains to be seen whether that's true or not.
It's not just banks that have to signal confidence to households, to businesses. It's also the Fed here still that is trying to move past its own credibility kind of crisis, if you will, coming off of 2021 and even into 2022. And so with that in mind, where do you expect the Fed's tenor to change as well, if at all?
Well, they used to say that they like to use the right tool for the right job, right? That's Bernanke's point. So use the different tools for financial stability than for monetary policy. That would be their ideal scenario. If they effectively ring-fence this problem, then the economy more broadly should continue to function well. And in fact, they would have increased liquidity with this new facility that they just rolled out. But that may not turn out to be true if some banks curtail their lending significantly, right at the time that the Fed is also conducting quantitative tightening. So they're also withdrawing liquidity from the market.
So that sounds like a risky proposition then in terms of indeed leading us into a recession.
Yes, I think the odds of a recession have
By how much?
It's hard to quantify, and the situation remains very fluid. But, as you guys brought up earlier in the show, even if we don't see a recession today, I think that really doesn't take care of the inflation problem then. They continue to hike, and the non-linearities associated with higher rates only increase. So we're getting these banking problems, and rates are not even they're not even at 5%. Obviously, markets had priced in over 5% policy rate a week ago, which partially led to this. But imagine what we might get at 6%.
Yeah, Sonia, I want to ask you, we keep talking about the odds of recession. And we also have talked about how the job market sort of lags that, right? That the job market, at least on the surface, still looks relatively strong, even as we keep debating recession. when we talk about how severe the recession could be and that the odds are going up, what does that imply for the job market? Does it sort of shorten the lag at all? Does it mean that an eventual jobs downturn will be more severe? How should we think about that lag effect?
Yeah, I think you could think of it as both. It's one thing to look at areas like tech, which actually tend to not employ a large percentage of the U.S. population. It's something else to look at small and medium-sized enterprises who do rely quite a bit on regional banks. So if regional banks curtail lending to small and medium-sized enterprises, you could expect more job losses there. I also think that, of course, you could have a lag effect with the job losses themselves. So when unemployment goes up, typically it doesn't just go up by 50 basis points. It goes up by more than that. And that is hard to monitor and arrest in real time. So I think both of the risks that you outlined are there.
All right, more to weigh on us here this morning. Sonia Meskin, thank you so much for your perspective. I appreciate it. Head of U.S. Macro at BNY Mellon Investment Management. Thank you. Coming up, social media stocks Snap and Meta getting a boost as TikTok faces a possible U.S. ban. We'll talk about that, and we'll have the opening bell on Wall Street. That's coming up. Coming up on the opening bell on Wall Street, and futures here are pointing lower right now. Not seeing a big decline, but it's interesting to see this negative action, even despite the actions that the Swiss National Bank, Brad, has taken to try to offer a lifeline, a liquidity lifeline to Credit Suisse. Yeah, that has been after we were in positive territory, actually, in the futures a little bit earlier for the Dow and the S&P 500. I thought the NASDAQ was going to hold on to that going into the start of today's activity. But yeah, so much focus on the regional banks coming into today's session once again. But at the same time, you've got a lot of movement, at least right now, in just trying to offer a backstop for some of the regional banks where there has been so much of the
consumer attention as well as the business attention focused on, all right, how liquid will we be able to still be in getting our cash, getting our assets, and some of those answers have started to come through, but still a lot of questions that are out there.
Well, and to your point, that it's a very separate, we've talked about the Credit Suisse issue and why it has repercussions. That seems to be stalled for now, but this other issue is not, and it just shows you how separate those two are. They both have to do with sentiment, but they are indeed separate. And that's the opening bell on Wall Street. You hear our market coverage here sponsored by Tasty Trade, and we got some bagpipers there.
I got to get one of those hats.
On the floor of the New York Stock Exchange. It's almost St. Patrick's Day. What am I talking about? Of course, this is why we got I assume this is why we have the bagpipers there. I guess it's St. Patty's Eve, and this is how one celebrates St. Patty's Eve there at the New York Stock Exchange, as you have the members of that NYPD Bagpipe Corps, I'm going to guess, Bagpipe Brigade. Let's see. The NYPD Emerald Society Pipes and Drums. It's also in honor of its 63rd anniversary. Not too often that you see a picture like that at the opening bell.
Well, they actually play those bagpipes on the floor of the exchange.
I'm sure they do.
When they come through, yeah. I've heard every song played on the floor of that exchange, my goodness.
Really? What's the most creative bagpipe cover you...
Bagpipe cover. I mean, you really only hear the bagpipes when they come through.
Right. That's what I'm saying. Like, what are they covering? I wonder. What songs are they doing?
Well, other songs that I have heard on the floor of the exchange is "The Circle of Life" before. Once the Lion King, the parade came through, it wasn't via bagpipe. It was just over the loudspeakers.
That would be something, though, if they did that one.
Quite eerie the day that they did play it. I'll tell you more about that in the break sometime. Yeah.
Sounds good. First, tell us what's going on with the markets, though.
Taking a look at the Dow Jones Industrial Average. Right now, it's down, opening up lower by about 0.7%. Let's put this on some chart activity for you so you can see how we've been faring over the course of the week. So over the past 4 days, net lower by about 0.8%, down here out the gate by about 0.7%. The NASDAQ composite, you're seeing that over the past 4 days, still holding on to gains here, but right now, early in the trading activity, we're seeing that lower by about 0.4%, and then additionally checking in on the S&P 500. There we go. That's down by about 0.6% to start the day. Still net positive over the course of this week, though. That's up by about 0.2% past 4 days. Let's take a look at a few of the heat maps that we've got loaded up here for you. We'll start with the regional banks. Still a ton of red on the screen here, and in fact, just red everywhere you look, to paraphrase the Full House theme song. But ultimately, taking a look, and this is the past 5-day scale. Intraday out of the gate here, still a ton of red. And in deep red, you've got a few of those names, and none more so than First Republic Bank. That's down by about 33% this morning. We'll add some more color to that in just a hot moment. I just wanted to zoom back out to the regional bank chart here. And if we can put this on an equal, just to give you a good look at things here. You've also got some activity on PacWest Bancorp as well here this morning, too. So with all of that movement, continuing to keep a close eye on the regional banks, given the fallout from Silicon Valley Bank, as well as a few of the other regionals that we've been tracking here this morning, too.
Yeah, the only 3 in the green, 2 of them don't exist anymore, really, or at least not right now. I just wanted to linger here for a moment because of the declines that we continue to see here. There was the pause, now the resumption. These reports that we might see First Republic put itself up for sale. That's not helping forestall the selling at all. I just noticed a tweet from Bill Ackman, who is criticizing the government now, saying the failure to provide a temporary guarantee on all deposits is causing an unnecessary banking crisis. I mean, I would submit that they've effectively provided an implicit guarantee, but I guess it's not explicit. It's hard to know what regulators should be doing now that they are not doing, or maybe there's things happening behind the scenes that we don't know about.
Yeah, we got the statement, at least specifically regarding Silvergate earlier this week from President Biden, but still, even more so, there had been, and even as I was out of town, as many of our viewers know, and our operations as well, there was so much focus on Silicon Valley Bank over the course of the weekend as to what needed to happen from a federal response standpoint. You got that from the FDIC. You got that from an in consortium from the Fed, from the FDIC and the Treasury. But now, with so much of the other focuses around what comes next for some of the regional banks, what this means for their customers and businesses at the end of the day, does there still need to be even more of a response, and what other mechanisms could come into the fray and to fruition? But as of right now, there's still the major question mark that lingers over many of these regional bank players, and what type of consolidation could this ultimately lead into and spur into as well in the near future?
And of course, looming over all of it is, what does the Fed do next week, and what effect does that have on all of us? So let's talk about some other movers as well. And this one also is sort of a ripple effect mover, if you will, or duo of movers. We're talking about social media giant Meta as well as Snap. They are making moves this morning, rising. That's after the U.S. government said it was considering a ban of TikTok if the owners, ByteDance, refuse to sell their U.S. holdings. And, you know, TikTok has tried to address this. It said, first of all, that its ownership is not an issue, but it also said that it would try to sort of wall off the U.S. users' data. U.S. authorities do not seem to be satisfied by that. I mean, it feels a little bit like a throwback, more than a little bit. It feels like a throwback to the Trump administration, where they sort of made that arrangement with Oracle to buy the U.S. business, and then it was blocked by the courts. So it seems like ByteDance might sue on if the Biden administration does the same. There's still a lot to track here, but this could benefit, obviously, the likes of Snap if it happened.
Yeah, it could. And you think about the amount of screen time that TikTok has been able to overtake from a core consortium of users, and that being largely Gen Zers, even a lot of millennials as well, who have flocked over to TikTok. The amount of time spent on the app that has no doubt siphoned off some of the time, the screen time and the screen wars, if you will, from a Snap, from Meta platforms and their subsidiaries in Facebook and Instagram, even though some of that time was already starting to be generated towards other areas anyway. So if there was an outright ban of TikTok, how would that benefit for screen time, translating into advertising dollars as well at the end of the day, and even more so into some of the in-app purchases that take place. And that's where TikTok certainly has made its own name for itself, generating $205 million more than Facebook, Instagram, and Snapchat and Twitter combined via in-app purchases revenue, that according to Apptopia data as well, who ran even more of a survey following Snapchat's offering of their own Snapchat Plus for, $3.99 a month or whatever last year.
Yeah, well, we're going to have more on all of this later in the show to try and game out the potential scenarios here. In the meantime, we have other Chinese tech news. Chinese search giant Baidu unveiled its artificial intelligence ChatGPT rival ErnieBot in a presentation on Thursday that disappointed investors. The shares are down 2%. So apparently in this presentation, Baidu didn't actually interact in real time with Ernie, right? They just rolled out this pre-recorded video. So the audience was like, well, we want to see the thing actually work. And we saw what happened when Alphabet tried to roll out Bard and had some issues with it. So Baidu's being similarly punished.
Right. I mean, you ask anybody, you could probably make a video of how well something does. Just think back to Magic Leap. They were really good at making videos, and of course, a couple of the other hydrogen-based or vehicle plays out there. All that said, investors were looking for an actual showcase of how this technology and generative AI, for Baidu's sake, how those partners could rely on this in real time. And if you're not able to display that, and all you're doing is making a video at the end of the day, you haven't really created a product that is ready to go to market immediately. And so now we're looking at the shares reflecting a company that doesn't have a product that is ready to go to market immediately. It's more a concept of a product that can go to market at some point.
Yeah.
But how do you price that into the shares when you don't know what type of pickup that will have, regardless of the number of partners that they had published at the time of this particular announcement as well from Baidu's sake? I think it was upwards of 600 partners that had signed on.
Yeah, and Baidu's founder, Robin Li, who made the presentation, also acknowledged that the product isn't perfect.
Yeah. I
mean, ChatGPT isn't perfect either, as a lot of the people who have been testing it have been illustrating, but they still sort of came out with it and just went for it. I just wanted to mention one sort of footnote or side note, if you will, to the AI bot discussion, and that's a stock called LivePerson, which is also in the chatbot business, and came out with a forecast that was lower than estimated, and so the stock is just plunging this morning. It's down by 53%. This is a company that's been around for quite a while, but it is in this AI chatbot business, and while some of the analysts are saying, well, there's obviously an opportunity a bigger opportunity here. They're questioning the execution of this particular company.
Yeah, if there's one thing I can layer onto this, especially given some of our coverage at South by Southwest over the past couple of days, there's been a lot of conversation around reframing the artificial intelligence conversation to an augmented intelligence conversation. Now, whatever the form of that augmented intelligence is going forward from here, especially as layered in with Live Person, as layered in with Ernie Bot or Bard, whatever the solution is that's brought to the fold, it's a matter of removing some of the own biases that are incorporated into these language learning models, given that you're going to have the input of sources from so many different places coming in. We could probably do a much deeper dive on that, but that is the kind of 30-second version, if you will, from what some of the industry experts are talking about in the repositioning and reframing around this. Also, let's talk a little Dollar General here on the day. Dollar General, ticker symbol DG. It's out with a miss on the top and bottom line as fourth quarter comparable sales. They came in below analyst expectations. You were taking a look at shares a moment ago here on your screen, and there's some of the actuals versus the estimates where it was a miss on both the top and bottom lines, as we mentioned here. Some of the commentary that the company did put out for Dollar General, they did say that the operating profit for the fiscal year, it actually did increase increased 3.3% to $3.3 billion. That's compared to $3.2 billion in last year. We do know, generally speaking, the dollar stores, whether it be Dollar General or Dollar Tree, they tend to do better when there is more of a tightening of consumer dollars here. So extremely important to pay attention to how the health of Dollar General looks in this near term as well.
Yeah, I mean, it seems like there was just a little bit of moderation here, and that seems to be why the stock is not performing better today. They also pre-announced, so that's part of it, but we did get more details. Gross margin coming in basically in line with estimates for Dollar General. Corey Tarlow, a friend of the show, Jefferies analyst, says the guidance reflects a moderation in net sales and comp sales growth, and also first half pressures from ongoing sales mix pressures. You know, and that, of course, is something that we saw at the likes of Costco as well, that people bought fewer discretionary items, more necessities. I would imagine that that would affect Dollar General a little bit less, but still perhaps is having an effect there.
And this is a company that's going through a repositioning as well of some of its stores. They had positive sales contributions from some of those new stores, growth in same-store sales, but that was partially offset by the impact of store closures. So the repositioning of those stores is going to be key to which markets regionally they're serving as well in this near-term period. We're also watching shares of Adobe on the back of its earnings beat. We'll speak to the software giant's digital media presidents. That's coming up in the next hour. You do not want to miss it. Shares, they're higher by about 3.9% right now. But coming up on the other side of the break, what are the top signs of financial stress? Yahoo Finance's Jared Blickbury, he's back with the details, baby. That's next.
We all know the FDIC protects your bank deposits up to $250,000. But what if you have your money in a brokerage account or even a credit union? We asked Bankrate.com Chief Financial Analyst Greg McBride.
If you have money in a brokerage account, this is something different from the FDIC insurance you have with your bank. Brokerages, if they belong to the Securities Investor Protection Corporation, they have this SIPC insurance, and that'll protect you up to $500,000 in losses in the event that the brokerage firm goes out of business. Now, that just protects the fact that your securities won't be part of that liquidation. It does not protect you against investment losses, and that's a key distinction. The value of your account is going to fluctuate. SIPC insurance doesn't protect you against that. If you have money with a credit union, this is likely federally insured as well. The National Credit Union Share Insurance Fund provides, similar to the FDIC, $250,000 worth of coverage to credit unions. Before you put your money in a credit union, just make sure that they are protected by that National Credit Union Share Insurance Fund. Just like with a bank, you want to make sure you're putting your money in a place that's federally insured. But as long as that's the case, you are protected up to $250,000, just as you would by the FDIC at a bank.
Welcome back, everyone. First Republic shares, ticker symbol FRC, has been halted for volatility this morning. You're looking at shares as they have been halted. They were down heavily to start off today's trading activity by a little more than 30%. We'll continue to monitor any movement or reopening, and this volatility trading pause typically happens for about 10 minutes or so. So we'll continue to watch that, and it looks like we do have some movement here. So continuing to watch those shares as we move on throughout the rest of today's session. It's been a wild week for U.S. markets, to say the least. Regional banks in the red once again today as the collapse of Silicon Valley Bank last week, leaving investors scrambling to identify other regional banks that have similar balance sheet issues. Our Jared Blickery has 3 more signs that we are in for more financial stress. Jared, what say you?
Yes, these are 3 signs, and by the way, these are all available with the Yahoo Finance app and also on our desktop of not the apocalypse, but of financial stress. And the first one, ticker CARET, VIX. You go to our homepage, you plug that into the search box, you're going to get the VIX, the fear index. And when we have rising volatility, as we have had very recently, and this chart goes back several months here, you can see, well, we've had a lot more stress in the markets. Now, let me just chart this real quickly for you. Over the long term, VIX is a mean reverting asset. This goes back 20 years. And by the way, this is a global financial panic, that spike up there. And this is the pandemic. In between, we have some panics here that were relatively minor by comparison. But you can see now that we are still at depressed levels relative to historical norms. Take a look at the 1-year chart of the VIX. We've had highs above 35. We haven't seen anything really north of 30, if only briefly, within the last few days to weeks here. So we also have the VVIX. This is a VIX of the VIX, and this is a little bit more sensitive. This tracks the volatility of the VIX index itself, and this is showing a lot more volatility of volatility itself. So that can be another helpful indicator. Finally, this is the ICE B of A Move Index, and this is like the VIX of the bond market, the treasury market. And we can see this is quite elevated, not to the pandemic levels just yet, or actually that might be, the pandemic levels, and certainly not to the global financial crisis levels, but something we definitely want to keep track of here. Now, we also have the Japanese yen. This is an indicator of crisis, because in times of crisis, money flows into the Bank of Japan, or flows into the Japanese yen. They are the ones to cut first, and they are the ones to hold out and raise their interest rates to last. So we have a strengthening yen. By the way, when this goes down, that is the U.S. dollar getting weaker, and that is the yen getting stronger. If this is going up, that is the U.S. dollar growing stronger. U.S. dollar growing stronger. Excuse me. So the ticker here is JPY equals X. Now, finally, we also have credit markets, and you can see by all these down arrows that I'm dodging, you don't want to see this in the credit markets. But for this, we have a lot of fancy things in the credit markets and derivatives. But I go to the ticker HYG. Now, this is a high-yield bond index. This is going to track the junk part of the markets. By the way, there's another ticker called JNK that does, or HYG and JNK, they do basically the same thing. And you can see here over the last 20 years, we've had some huge down spikes. Now, down means bad for the credit markets. That is the value of the bonds they represent. Those are decreasing as well. And when it's rising, that is a signal of risk on. So we are already at depressed levels, but let's take a look at a 3-month chart. You can see, despite all the panic in the market, we really haven't seen HYG plummet. When we finally do see that capitulation, that's probably going to be a sign, just like a move into the yen, that we are very close to the bottom, but we are not seeing that yet. We have to see that, I would say, explode to the downside. Now, one more thing with HYG, the Fed has an implicit put on this, because over the pandemic, they were basically buying HYG and JNK to support the corporate bond market. So with that said, maybe these levels are reflecting that Fed put, but I still believe there will be a capitulation moment, and there are other indicators to indicate exactly how that will unfold.
But they're not buying that anymore. That's done, right?
No, that program is done. They are unwinding, or they may have already unwound those purchases. So they are definitely not in the market now, but they could make an announcement. And those announcements themselves are basically pricing in those facts for the market.
All of this leads me to believe there's more downside, is the message I'm taking.
Unfortunately.
It's a painful one. Thank you, Jared. Appreciate it. Well, Senator Elizabeth Warren is calling on Signature Bank for answers. In a letter obtained exclusively by Yahoo Finance, the Massachusetts senator demands an explanation from the failed bank for its, quote, economically disastrous outcome. Yahoo Finance's Jennifer Schonberger got the letter. She's got the details. Jen?
Good morning, Julie. That's right. In a new letter obtained exclusively by Yahoo Finance, Senator Elizabeth Warren is demanding answers from now failed Signature Bank. She says engaged in excessive risk while leaning into a get-rich-quick scheme when it comes to taking on crypto customers. In a letter to CEO Joseph DePaolo, Warren writes, "You owe your customers and the public an explanation for the economically disastrous outcomes you created. You worked hard to weaken the rules, promised that they'd bode well for your bank, and then destroyed it with bad decision-making and excessive risk-taking. Congress and the public must learn the lessons from the failure of Signature Bank." Warren argues in her letter the bank fought to support efforts to roll back capital requirements and the Dodd-Frank Wall Street reform law and funneled thousands of dollars in campaign donations to leaders of the effort to loosen bank regulation in Congress. Warren also alleges the bank took on excessive risk to boost profit-serving cryptocurrency clients. She says, quote, "Signature Bank bought into its get-quick-rich narrative. Signature Bank was caught short because it embraced crypto customers with insufficient safeguards." Signature Bank, which served a lot of crypto clients, including defunct FTX, was seized by regulators Sunday, becoming the third largest bank ever to fail in the U.S. Now, Senator Warren has introduced a bill along with Representative Katie Porter to repeal that 2018 law that rolled back capital requirements and resubject small and mid-sized banks to that Dodd-Frank reform law with regard to annual stress testing and capital requirements. Senator Warren has also called for clawing back executive compensation from DePaolo and other executives. Guys?
Jen, thank you so much. Thanks for bringing us that. Warren has been obviously very active on this front. Well, coming up, oil markets attempt to recover after suffering one of the biggest single-day drops since 2000. We'll speak with the trader next. Oil prices are holding somewhat steady this morning after Credit Suisse's woes sent prices plummeting yesterday. Joining us now is Phil Strebel. He's chief market strategist at Blue Line Futures. I mean, Credit Suisse and like everything else, I suppose, contributing to what's been going on in oil prices, right? I mean, there's so many dynamics at work right now, Phil. You got what's happening with Russia. You have the Strategic Petroleum Reserve here in the U.S. and supply, that affecting supply. What do you think is sort of paramount in your mind as you're trading oil these days?
Yeah, I mean, this past week has just been fast moving for the global markets and policymakers. We went from expectations moving for like a 50 basis point rate hike in the U.S. to going to stress testing banks. And now the odds of a rate cut, are really quickly hitting and swiftly hitting demand driven commodities such as crude oil. You got volatility, systematic risk, and contagion fears. That's kind of the three themes that's on every single trader's radar right now. And crude oil is a very, demand driven product. You've seen deterioration, in China with their with their demand growth. We were expecting a snapback recovery after they lifted those COVID restrictions. And you got deterioration of U.S. and European, the economic outlook. And I can't believe that the ECB went through with that 50 basis point rate hike today. It's just going to further add, fuel to the fire.
Okay, and so for anyone who is looking to invest within this sector, what is the first thing that they need to remember?
Well, they got to remember that, this is a demand-driven product, and you've got supplies up at 18-month highs. You've got demand continuing to come back down. Oil prices are down about 14% on the year. You got, it's looking a lot better than natural gas, which is down 42%. So you got to have a long-term approach. You got to be looking for an economic recovery in order to get involved with it. We do like crude oil futures. We do see value in these mid-60s, but I think you got to have a long time on it. So you got to look at like the December futures contracts.
Can we also talk a little bit about the Russia dynamic, Phil? Because there, it just feels like the Russia supply coming to market is a lot higher than it looked when all the sanctions and everything started. Is that going to stay? Is that now the norm that you just have to consider price into the market?
Yeah, they went out, they found other buyers out there. They continue to pump their output. OPEC continues to create surpluses unless they can, coordinate some kind of cut. You're going to see those oil supplies remain at those elevated levels. And, Russia, they diverted. They started, looking at guys like India and China to sell to, and they found those buyers there. So, the supply is continuing to grow out there. You've got to really see kind of a couple different things happen. You need that OPEC to do a cut, and then the U.S. needs to take advantage of it. Where we're at right here, and the administration needs to refill the SPR. And I think that could push oil prices back into the 70s. We recapture $75, and I think we got bull momentum from there.
What if that OPEC cut doesn't come?
Then you're going to see a new price band on oil, which is about that 65 to 75 instead of 70 to 80, which we've seen over the past few months.
What about what's going to happen with oil stocks as a result of all of this? I don't know how much you're in the stocks versus the commodity itself, but how are you thinking about positioning there and whether you should be buying, selling, just staying pat?
We see long-term value in it, but they are going to face some headwinds. I mean, they do face that systematic risk of all the other stocks. They're not completely isolated whatsoever. U.S. production right now and inventory levels is, massively higher than what the 5-year estimates are. Normally around 5 years out, last 5 years, we've averaged 450 million barrels. Right now, we've got 480 million barrels. So we're flush with inventory right now. These companies really are looking at more cost-cutting measures in order to boost profitability at the moment.
Okay, so what's your outlook for gas prices from here? Everyone's trying to figure out what their summer plans may be over the next few months. So what should they expect as we get into those summer months?
Yeah, you look at gasoline prices, they've come down significantly. Gas prices tend to peak right around Memorial Day weekend, and then they're pretty stagnant because those supplies have been built up. I think inventories are already remaining at an elevated level, so I think it's going to be real good for the consumer at the start of the year. If you get the economic deterioration in the volatility in the market, you get that demand really coming off, you're going to see gas prices continue to drift lower. So I think it's going to be a good year for those that are driving out there, and we'll probably start to see tightness again back in the fall.
Wow, good news. Some good news today. I will take it. Phil Strebel, thanks so much. Blue Line Futures Chief Market Strategist. Thanks for your time this morning.
Thanks.
And let's take a look at one trending ticker. That is UiPath. This is a software company that just came out with its numbers. And the company's shares are up 15.5%. It's one of our trending tickers as well. Obviously, the company's annualized recurring revenue in particular strong here. That's one of the measures that people watch closely for these software companies. And we're also watching shares of Williams-Sonoma. That's another trending ticker for us here this morning. The company coming out with comparable sales that were below estimates for its fourth quarter, falling by 0.6%. It looks like West Elm was the weakest among its brands, seeing a drop of 10.7%. Williams-Sonoma namesake brand down 2.5%. Pottery Barn doing all right. Its comps were up by 5.8%. At the same time, the company is also announcing a 15% boost to its dividend and a new $1 billion stock buyback authorization. So that might be cushioning some of the blow from those lower numbers. We'll be right back.
Welcome back to Yahoo Finance. I'm Brad Smith alongside Julie Hyman. Let's take a look here at the broader market action after the ECB, the European Central Bank, as you know, I'm in your hood. They delivered a 50 basis point interest rate hike. The three major averages here in the U.S., they are mixed right now. The Dow and the S&P 500 are in the red. The Dow lower by about 190 points, 0.6% there. S&P 500 to the downside by about 0.2%. And then the NASDAQ composite, you're seeing that hold on to some gains right now. It's up by about 0.1% right now.
And U.S. Treasury Secretary Janet Yellen is set to appear before Congress today. Here with what we can expect to hear from Yellen about the banking system in the wake of 3 U.S. bank failures is Yahoo Finance's Jennifer Schomburger. And I know she's set to begin momentarily.
Good morning, Julie. That she is. Treasury Secretary Yellen set to tell lawmakers before the Senate Finance Committee this morning that the U.S. banking system remains sound, even in the face of a drop in liquidity that we've seen in the Treasury market and ripple effects from 3 banks that have failed in just the past week. Yellen will tell lawmakers, quote, "I can reassure the members of the committee that our banking system remains sound and that Americans can feel confident that their deposits will be there when they need them. This week's actions demonstrate our resolute commitment to ensure that depositors' savings remain safe." On Sunday, Yellen, in conjunction with the Federal Reserve Chair Jerome Powell and FDIC Chair Martin Gruenberg, announced the government would backstop all deposits from failed Silicon Valley Bank after its seizure last Friday. Yellen will say, quote, "Importantly, no taxpayer money is being used or put at risk with this action. Deposit protection is provided by the FDIC, which is funded by fees from banks." She reiterates stock and bond investors are not protected by the government. The Fed also said Sunday it would offer funding to banks through a new facility to help ensure banks could meet all depositor withdrawals, essentially backstopping all deposits, both those insured and uninsured, across the U.S. financial system. Now, Treasury Secretary Yellen is set to testify on President Biden's proposed 2024 budget, but she is going to be getting a lot of questions from lawmakers about the failure of Silicon Valley Bank and all of the ripple effects we are seeing now. I will bring you those headlines as I get them. Back to you.
Know that you're going to be paying close attention to it for those headlines. Jen, thanks so much. Let's get to Julie now for a closer look at some of the market moves this morning. Julie, what are you watching?
Oh, so I'm going to step away from stocks for just a sec. We'll get back to them. But I want to talk about what's been happening in the bond market because it is just so extraordinary. The decrease we have seen in yields, the increase that Jared has been hammering home that we've been seeing in volatility here. And so this is the past month that we have seen in the 10-year. Of course, it was a milestone when it went above 4%. We were seeing really across the yield curve 4% at least for the 2-year, the 10-year, the 30-year. Well, it's a very different scenario now as we have seen the failure of SVB, as we have seen more concerns start to come in and questions about what the Federal Reserve is going to be doing. And so now we're seeing a 10-year yield of below 3.5%, forget 4%. So just something to continue to track here. I'm also, of course, continuing to track what's happening in the banks. And here is the regional banks. I've got it on that 1 month. So let's go back to today because we continue to see these steep declines here. There is obviously still concern around the regional banks, particularly the likes of FRC, et cetera, about what is going to happen next, right? Is now this bank going to be required to be shut down or bailed out? Certainly there is a confidence issue, it seems, when it comes to some of these banks. This stock down 30% just today after that bounce we saw for it yesterday. For the large banks, too, we are still seeing some weakness there. The likes of JP Morgan, Morgan Stanley in particular, off by more than 2% today. Let's take a look at the sectors, too, because here we are still seeing weakness in energy. That has been a consistent theme this week, even though we've been talking a lot about the financials. Sneakily, the energy stocks have been quite weak as well, as we have seen that drop in oil prices that we talked about with Phil Striebel. Real estate down as well today, and then the financials there right in the middle of your screen. Consumer discretionary, interestingly, is up today about 0.2%. So not a runaway leader, but it is leading to the upside. Quick check on the NASDAQ 100 movers as well. And there you see a much more mixed picture here as the attention really has been shifting towards the financial industry. So what do you do now as an investor? Where do we go from here? There are so many uncertainties in this environment. What's going to happen with the regional banks? Is there more risk in the system that is hiding, that is yet to emerge? And over it all, what is the Federal Reserve going to do next week? Let's get some counsel from Tony Dwyer, Canaccord Genuity Group Chief Market Strategist. Give us all the answers, Tony. What should we be doing in this environment?
I think my history shows clearly I don't have all the answers.
Yeah. None of us do. It's okay. It's okay. So how are you thinking about, what's your framework now for thinking about all of those uncertainties in the market?
So, Julie, as you know, I've been cautious for the better part of the last year, 9 months. Here's the issue. You have a Fed that has raised rates in a historic way. You've never had the rate hike cycle this fast. Even when you go back to the Paul Volcker era, or any other cycle, you have not raised rates this quickly. The problem is when Paul Volcker did it way back when, in the early 1980s, you're at a generational low in debt to GDP. We're at a generational high in debt to GDP, and that doesn't even include the private debt that's funded private equity and private credit and venture. So a lot of the issues that are coming out now are, the long and variable lags, which is annoying as all heck to hear that every other sentence from people like me. But this is the implication of that. We're just basically 6 months away from that first 75 basis point hike, much less the next 3. So we've got a little ways to go here before bad news is really discounted as bad news and it's time to be aggressive.
So what do you believe is the next shoe to drop in that long and variable lag, and ultimately what you're describing within this outlook for still some pain that is yet to come?
Right. I think it's really inappropriate for people like me to come on TV and pretend like we know the next shoe to drop. Obviously, nobody saw the Silicon Valley Bank thing a week ago. So let's put that up on a mantelpiece. Let's talk about what we can analyze and don't have to guess at, and that is financial conditions. You've been in a situation again for the last 9 months where you've seen rates go up, which means interest expense goes up. You've inverted the yield curve. So when we ask the question, we've already tightened monetary policy to a degree and financial conditions to a significant degree. Do all these banking issues help or hurt financial conditions? And most certainly it's going to tighten them. So you've always had a recession when you've inverted the yield curve anywhere near the current degree. You've always had a recession when the Conference Board leading economic indicators have hit the current levels. You've always had a recession when bank lending standards have been tight to the current degree, much less what's going to probably happen after the bank issues. So what we can analyze rather than try to figure out the next shoe to drop is how does the economy go into recession? And that's been our call. It remains our call. And I think the banking issues reinforce that call.
And so I guess then the question is, why the heck would you want to take risk in this environment, right? So if you do want to be more cautious, if that is the scenario, and certainly the last week has not made you feel any safer in this market, I think, you being everyone, how do you do that then? How do you wisely avoid risk and still get a return?
Julie, as you know, there's always times where the market gets oversold and it can have this, kind of counter trend rip. We're getting pretty close to being oversold where you can bounce, but ultimately to really take risk, we haven't been there. We don't expect to be there near term. Our framework has been to be quote unquote light and tight, meaning, light in exposure. So if you have excess exposure, lessen it. And we would rather be slightly defensive. But the key is, and I think the most important differentiation that I can give versus some of the people like myself that come on is the 3 stages of a bear market are: first, good news is bad news because it means the Fed's going to raise rates on higher economic activity and elevated inflation expectations. Then bad news becomes good news because, well, maybe we can get a soft landing and the Fed won't raise rates as much. And then ultimately, when all those indicators I talk about before I get to the current level, bad news becomes bad news. And that's the bull story. The bear story, the worst case scenario, was always a soft landing because it keeps the core services that the Fed watches so closely elevated. You unfortunately need to have unemployment go up. Unemployment goes down on an escalator and up on an elevator. And when it starts to go up on an elevator, that's when you want to attack and take risk. We're getting closer to that as bad news becomes bad news.
Okay, and so that started to answer some of my question as to what the green light might be for perhaps getting to the other side. But I guess on the calculus of how severe a recession might be, where are the clear plays that investors can lean into if they have a long enough time horizon?
Well, right now, short-term T-bills, even as they've come down, offer pretty good safe haven there. But again, we're only saying that we want to be slightly defensive because the problem, Brett, as you know, is when you're in a whoosh, it's a technical term, but when you're in a real whoosh, people get all bear. Kind of look now. All the bulls are kind of flipping, saying that there's risk in the system. The odds of a recession are going up. You think? So what happens is people start to get more bearish as stocks go down. in this phase, when bad news becomes bad news, if you're too negative already, it's going to be hard to change. So I don't want to get too negative. Time to be really negative was last June and last spring, when some of the stocks were 75% higher. Now's not the time to get excessively negative, because the Fed is obviously going to shift. The 2-year note yield's telling you that. I want to attack that new low if it comes, rather than try to fear it and play for it, because I think that's the opportunity, is when the Fed begins easing financial conditions and we can look through the coming economic weakness. That's the time you want to become more aggressive. And I think that's why the bull story is actually more sharp economic weakness rather than some kind of soft landing.
Gotcha. Makes sense. Thanks for talking us through it all. Tony Dwyer, Canaccord Genuity Group Chief Market Strategist. It's always great to see you. Thank you.
Thanks for having me.
And our trending ticker right now, cheers of Virgin Orbit Diving, as the company is furloughing nearly all of its employees and pausing operations for a week. This comes as the U.S.-based satellite launch company looks to conserve capital while conducting discussions with potential funding sources. Virgin Orbit anticipates providing an update on go-forward operations in the coming weeks, but the shares in the meantime are trading under $1, and they're down more than 30% today. Well, coming up, we are going to be digging more into the situation with TikTok and that potential ban coming from the United States. Stay with us.
The Federal Deposit Insurance Corporation, or FDIC.
FDIC.
The FDIC.
The FDIC.
The FDIC, the Federal Deposit Insurance Corporation, was established during the Great Depression to restore our faith and our trust in America's banking system. But what does it do?
Its job is to protect your deposits that you put in regulated banks. Regulated banks will have a sign that says FDIC insured, and it will also say what the deposit limit is. The current cap is $250,000. The FDIC has a perfect record of protecting insured deposits. Not only that, but the policy has been, we did it every single time during the Great Financial Crisis. You'll have access to your insured deposits within 1 business day if your bank fails. For those who have more than $250,000, though, they should be aware that if the bank fails, they may not be protected.
So how do banks turn a profit? Well, they keep a portion of the money you deposit as cash or reserves to handle those day-to-day withdrawals. But the majority of your money is invested, and it's invested in mortgages, car loans, treasury bonds, the list goes on. And they make their money from the interest that's earned on those investments.
But sometimes banks do stupid things with your deposits. Yeah, doesn't happen very often, but sometimes it does. And that's why the FDIC is there. If the bank does stupid things with your deposits and loses too much money and becomes insolvent, the FDIC is going to swoop in and make sure that your insured deposits are whole.
Let's do a quick check of the market sponsored by Tasty Trade. We saw the markets pretty steady here to the downside in today's session. As we've seen in recent days, the Dow is leading the way down because of its weighting, the bank's weighting in that index. It's down about 0.9% today. The S&P falling 0.6%. As we told you, energy and financials are weighing on that. And the Nasdaq down the least today, down just 0.25%. And sticking with tech, Adobe is getting a boost today after the company raised its full-year forecast and saw revenue jump 9% year over year. Adobe Digital Media Business President David Wadhwani joins us now. David, thank you so much for being here. Obviously, the numbers look good. They look good in your division in particular, showing that there is still demand. I want you to give me a little bit of color, if you can, on that demand. Who is buying the product, and is there any vulnerability to what we're seeing in the broader economy right now?
Thanks for having me, Julie. Yeah, we're very pleased with the first quarter, and it's a great start to the year. And, in this dynamic environment, we track all the different inputs that we get. The foundation of the growth that we're seeing continues to be the primary fact that in a world which has this much dynamics in the market at the moment, there's a flight to engage with your customers in ways that are going to increase your opportunity as a company. And that is really founded and based on the fact that you need to have a lot of great content, and you need to engage your customers through that content digitally. And so that gives us as Adobe many different growth drivers, whether it's the ability to attract new users, the ability to upsell existing customers to new value and the new innovation that keeps coming out. We have the ability now to, because of the need for content, we've invested a lot in product-led growth so that we understand through data what our users are doing and drive them to the content or the technology that's going to give them the best outcome and drive new value. And we have just an incredible amount of new users coming out to the platform, both from education and the growth of the creator economy. So wherever we look, whether it's large enterprises or small solopreneurs, digital content production and engagement is really where the game is, and that's really what's driving our growth.
One thing that we've heard from companies that are restructuring their own costs is that they are being internally more scrutinous about the deals that they get done with some of their larger kind of license providers, and Adobe could be seen as one of those businesses. Has that had any material impact on Adobe, at least in this recent quarter, or is that factored in even to the guidance going forward here?
Everything is factored into the guidance that we're aware of. One of the things that really helps us is the diversification of the business. We have end-to-end solutions, whether it is in the digital media business around Creative Cloud, whether it's in the document business with Acrobat and our services there, or whether it's in the digital experience business. What we're seeing is that companies, especially large enterprises, are moving more aggressively to digital engagement, like I said before. What they're doing is they're being very selective about where they start and how they grow. And because we have such a broad portfolio, they know that wherever they choose to start, whether it's in campaign production or whether it's in doubling down on video, we have a offering for them, and that they know that as they grow and as they go deeper in their spend and their strategy, they can grow with us. So we feel that we're in a very advantaged position because of the breadth of our solutions and the footprint that we have globally as well.
And also in an advantaged position, perhaps, in terms of talent. And I want to dig into that a little bit, David, because I don't think you guys have done any layoffs like many of your peers in the tech industry have done. Are you hiring? Are you scooping up some of the folks who maybe have lost their jobs elsewhere?
Yeah, it's a great question, Julie. We have always prided ourselves in being a very disciplined company. So as the market was growing very quickly, we focused on, as our CFO Dan likes to talk about, the rule of 60. We feel that we always focus on profitable, disciplined growth, and then are prepared for these moments where there are market corrections. And we very much see the opportunity now to double down on innovation. We have a lot of great announcements coming out around generative technology next week at Summit. And as we move into these new areas of innovation, the ability to hire great talent that's being let go by other companies is phenomenal. And also don't underestimate the stability that it provides existing employees to know that we've invested wisely in them, in their careers. And we get to really benefit from the stability and focus now while many other companies are going through transition.
Some companies have leveraged artificial intelligence as a means to cut some of their own headcount footprint that they have. For Adobe, what does that look like if you do have solutions that are going to be integrating AI or generative AI? Of course, there are so many different forms that AI can come in, but at the end of the day, does that mean more employees that would be additive to what that experience for the Adobe solutions would look like in the future?
Yeah, at the end of the day, we look at the market and we say the thirst for content as a vehicle for communicating and engaging with your constituents has never been higher, and it will only continue to grow. We talk about the need for personalization at scale. We think ultimately a brand is going to communicate with their customers through a content supply chain that's really focused on them as an individual as opposed to a group of people. And with that demand for content comes a thirst for personalization and more jobs, frankly. Where we've seen people pull back a little bit is in terms of the budget and the spend of the distribution of the content. But we are seeing and certainly experiencing that companies are still growing in terms of the people needed to create that content. And where generative tech comes in is the ability to do what we've been doing for decades, take AI and make the people creating the content more effective and more efficient and more productive so that they can really focus on the things that they do best, which is think about the creativity and how they express themselves and their brands in new ways.
And David, I know, as you mentioned, you're making an announcement on the AI front at your summit next week. So I don't want to. Well, I mean, if you wanted to tell us right now, I wouldn't argue with you. But I mean, what you were just saying, what's an example you can give of how you're integrating generative AI so we can sort of wrap our heads around it? What's an example of how somebody who is buying your software is going to see that in play?
Yeah, it comes down again to this basic concept that there's more demand for content than ever before. And what we hear from our customers is that their ability to keep up with that content is always a struggle. And we have basically looked at generative AI and we've said, how do we use generative AI to enhance their existing application workflows? So we've been focused on three core areas. The first is around the quality of the output. Generative AI is going to get better, and we believe we're the company to make it better. So we're taking the latest and greatest generative AI technology. We're building our own model. And we're adding in what we've referred to in the last decade as Adobe Magic, all the work that we put into imaging and video and 3D to make the output better. The second is around commercial use. There's a lot of complexity associated with copyrights, diversity and inclusion, harmful content generation. How do we make sure that the content we produce is ready for commercial use? And then thirdly, workflow integration. And when you think about generative technology today, the creation of content is really just the start of what we need to do with that content. There's an entire workflow that comes in beyond that. And that's where Adobe comes in, is taking that great content that we generate with our model, but then integrating it into Photoshop, into Illustrator, into After Effects, and also into our DX and Document Cloud products. So you can imagine someone being able to generate a brush in Photoshop to extend an image or outpaint or in-paint and really change the image based on that generative technology as part of their natural workflow, as opposed to a disconnected process.
David, finally, I would be remiss if I didn't ask you about Figma, which is a deal, $20 billion deal that you guys are working on closing before the end of the year. And your CEO in the call expressed a lot of confidence about the deal potentially closing. It might indeed face some challenges from the U.S. But I'm curious how you guys are thinking about that as you go forward, especially sort of given the environment in the Valley right now, given the collapse of SVB, If Figma doesn't happen, I wonder if you could even get some better deals elsewhere, right? How are you kind of thinking about your overall M&A strategy right now as a result of all this?
Yeah, it goes back to the point that we talked about discipline. We're disciplined about, how we leverage our capital. We're also disciplined about looking for long-term opportunity. We feel that the merits of the Figma case are amazing, both in terms of our ability to, actually all three, in terms of our ability to accelerate their business, their product design business, the ability for their platform to accelerate what we're doing with our core creative categories around real-time collaboration, which we believe is going to be the foundation for the next decade, and their ability to get us into the creativity market, take the creativity market and make it a more mainstay in the productivity market, which opens up a massive new addressable market for us. So the foundation of the business there, the foundation of the financial case there around the long-term vision here continues to be very strong. And we believe in the merits of the case. So we're very confident that the Figma deal will close and that will grow. And then also putting that in the context of the core business continues to do amazingly well. And it just adds yet another engine to our growth.
Salesforce has already disbanded their M&A unit for the next 2 years, it seems like. Is Adobe, if Figma does or doesn't go through, does it seem like after this you're going to kind of step away from deal making?
Yeah, we believe, Adobe's always grown through amazing investment in organic internal design development. You'll see some of that, on display next week at Adobe Summit. We're very excited about what we're going to launch there. But it's also been built through, amazing acquisitions. I myself came in through the acquisition of Macromedia, and so we are a company that looks at innovation in this bimodal way, and we'll continue to do that. That's always played very well for us.
Adobe Digital Media Business President David Wadhwani. We're going to be looking for more of those details to emerge next week. Thanks so much.
Great. Thank you, Julie. Thank you, Brett.
Got it. Coming up, the TikTok crackdown escalates. What a possible U.S. ban could mean for other social media companies. That's next. The U.S. is doubling down on its TikTok threats, urging Chinese owners of the app to sell their stakes or risk a total U.S. ban altogether, as first reported by the Wall Street Journal. But how will this impact other social media giants? Roth Capital Partners Managing Director Rohit Kulkarni joins us now. Rohit, great to have you here and get some of your insights on this. It seems like what is old is new again, as TikTok is really being targeted here in the U.S. What do you expect to come of it, and is there anything different this time around?
Hey, thanks for having me. I think this is probably still, we are still very early with the general job owning that we expect to have over the next 30, 60, 90 days. I feel based on what CFIUS has been working with TikTok over the last 2 years, the outcome that CFIUS has concluded that this needs to be escalated, and they're clearly unhappy with the way data restrictions, privacy concerns need to be to some extent satisfied. So I think we're still very early. I feel TikTok is in the hot seat right now. That cools off some pressure from the peers from a sentiment standpoint. Whether that translates into more fundamental improvement, that remains to be seen. But sentiment drives stocks, and that's what's driving Facebook, Snap, and Pinterest today.
Of course, stocks don't have a lot to do with whether 15-year-olds are going to migrate back to Snap from TikTok, right? So I am curious if this assumption that if TikTok went away tomorrow, that people would be flooding to Snap and some of these other services. Is that right? Is that how we should be thinking about it?
Flooding would be an exaggerated term, Julie. The way I would put it is slow migration back to the influencers that they follow. First the influencers, then the followers. I think larger platform like a YouTube that has shorts, or obviously Facebook and Instagram that have their own version of their mini TikToks going there, would be able to find those influencers back onto the platform, and then that would lead to some of the usage going back. Obviously, there is this only so many hours that you can spend in front of the phone while scrolling those videos up and down. And if TikTok is taking the majority share and that goes away, what would the young teenagers do? Start talking to their parents? I don't think so.
Definitely not.
I mean, look, Rohit, I'm old enough to remember when Kylie Jenner, I think, posted, "Does anyone else not open Snapchat anymore?" Is it as simple as, hey, I guess we're going to be going back to Snapchat, everybody? Like, at the end of the day, there are, as you mentioned, the influencer move that would probably bring the wave of the other followers, but at the same time, it's the monetization for so many of those influencers as well, who perhaps have changed their entire platform strategy. What does that translate into dollars, as much of the attention now has been focused on in-app purchases for the other platforms outside of TikTok and TikTok as well?
You're spot on. I think monetization is going to need a change in strategy, and that I think as this situation evolves, probably we'll see that strategic focus evolve as well. To some extent, the bifurcation in what the value prop TikTok brings, whereas the other platforms bring, has kind of widened over the last 12 to 18 months. By that, what I mean is TikTok tends to become more of a top of funnel brand marketing, awareness, and reach related kind of an ad platform, whereas Facebook or YouTube have started to become more of a bottom of funnel, more direct response oriented platform. So as more advertisers want to reach just younger audience, they probably go towards TikTok, and then maybe they go to Snap, maybe as a backup. So I think the first and most immediate beneficiary, I would say, Snap, given the smaller scale and a slight bump up in some of the advertisers looking at Snap away from TikTok could help them more as compared to the larger guys like a YouTube or Instagram that would need a much bigger needle moving change in their strategic focus, and that may require some time. So that could be just a tactical way to play on this theme over the next 30 to 60 days.
Yeah, that's an interesting way. Good way to think about all of them in perspective. Rohit Kulkarni, Roth Capital Partners Managing Director. Good to catch up with you.
Thank you.
Coming up, why you should care about Credit Suisse and putting it in perspective versus the SVB collapse. We'll explain next. Shares of Zurich-based Credit Suisse are recovering from its biggest one-day loss after securing a loan from the Swiss central bank. Although it's thousands of miles from the U.S., Credit Suisse woes could spell trouble for American markets, or at least that was the concern. Let's take a closer look at why that is. And I think it's helpful to put it in perspective versus what we saw from Silicon Valley Bank and the concerns around that, as well as Signature Bank and now some of the other regional banks, right? So to sort of compare and contrast a bit and why these are two different stories and two different areas of concern. First, you have to talk about the size of these various institutions, right? Credit Suisse, most recent reporting, had assets of about $575 billion or so. And of course, it reports in Swiss francs. We've converted them for convenience here. Around $200 billion was the latest assets for SVB prior to its collapse. If you look at deposit growth from these two companies, because both are deposit-taking institutions, SVB had about $173 billion in its most recent report. That was a downtick, but before that, you saw a surge in deposits, which was part of the issue, right? A huge surge in deposits from Silicon Valley, from VCs, from tech startups that then started to withdraw that money as they needed it, as they were feeling various economic duress and duress from higher interest rates. In contrast, if you look at Credit Suisse, which, as we've talked about, has had issues for years, it really had steady deposits until a more dramatic drop-off in its latest reporting period. So we look at those in terms of size, and then we also have to talk about them in terms of where their business lies. And this is really the key differentiator. Credit Suisse's two biggest pieces of its business are in wealth management and in investment banking. Investment banking, everything from trading to advising on mergers and acquisitions. On the flip side, SVB, its main business, 84% of its business was commercial banking. That means deposit taking and lending with its core constituents. We're talking about, again, venture capital and startups. So really very different businesses for these two different banks, which brings me to why Credit Suisse is of concern to the international banking system. Silicon Valley's concerns much more concentrated in the tech industry, right? And not seen as a systemic risk necessarily to the U.S. banking system, even if it could cause some economic risks when those businesses that rely on it, for instance, were afraid they couldn't make payroll. Credit Suisse's risk has to do with something called counterparty risk. That is, who's on the other side of a trade. There's always two sides to a trade, right? And so counterparty risk has to do with the idea, the potential that the other party in any kind of investment or trading transaction may not fulfill its part of the deal, could default on its contractual obligations. In other words, if I have made an agreement with Credit Suisse to sell it something, to buy something from it, if it has a liquidity issue, am I going to receive my money? So that's where the concern comes. Banks do business with each other, of course, internationally. Credit Suisse is one of those banks that is seen as systemically important on a global basis. So the idea that there was a potential that it could default on or not fulfill its obligations is the reason why we saw a spike in its so-called credit default swaps. Remember, we've talked about the definition for that. That's effectively insurance against a default. And various reporting out there has been that some of the people buying these credit default swaps, the insurance, were Credit Suisse's counterparties. In other words, they were insuring against the potential that Credit Suisse would indeed default. The idea that the Swiss National Bank has now come in and offered this liquidity lifeline to Credit Suisse makes it less likely, much less likely, that it would default and that there is the perception of default. So those prices on those CDSs should come back down. So hopefully I've put this in perspective, Brad, in terms of how people should be thinking about these two institutions and why there's concern about each of them.
Absolutely. Well broken down. And yes, you have put it in perspective extremely well. For those of us who are still getting up to speed, honestly, because I'm still in Austin, Texas. Yeah. Guys, coming up, the CEO of clothing and home goods retailer Lands' End joins Yahoo Finance to share the inside scoop on the company's most recent quarter. There you see Andrew McLean. We'll talk to him next.
Unrealized losses.
The unrealized losses.
We've been hearing the term unrealized losses a lot lately, but what does that mean? It's basically losses that are on paper. If you have an asset on your balance sheet as a company, an institution, it fluctuates in value, right? Because it's something that is pegged to the market. If that asset has gone down in price on paper, that is on your balance sheet, you have recognized a loss, an unrealized loss. That loss only becomes realized when you have to sell that asset if the price has gone down. One maybe easier way to think about it is to think about a real asset that might be on your personal balance sheet, like a house, for example. Let's say that you buy a house at $300,000 and you live in that house for a while. But then something happens in the housing market. The price of the house goes down a little bit, say to $250,000. That means it's an unrealized loss. You haven't sold the house, you still live in the house. If something happens and you're then forced to sell that house, you take a realized loss. That unrealized loss becomes realized because you've made the sale. But let's say you live in that house for a while longer and the price goes up. Well, then you don't have an unrealized loss anymore. You actually have
a gain. So that's how we can think about these various issues. These losses don't become realized unless, like some recent companies in the news, you are forced to sell for whatever reason.
Land's End's fourth quarter loss suggests strong promotions during the holiday season weren't enough to offset inflationary pressures and supply chain collapses in the broader economy. For more on the company's Q4 results, let's get to Land's End's CEO, Andrew McLean. Andrew, great to have you here. Help us break down this quarter. What were some of the catalysts? What were some of the detractors here that you look at and hopefully are able to continue to turn the ship here?
Yeah, thank you. We came into the quarter, things were a little tough. We had bet on sleep. It had worked well for us during the pandemic. A number of other retailers did it, and we found ourselves drowning in sleep along with many of our other competitors. And we had to liquidate that inventory. Where we really started to turn the ship was when we looked at our data. We do have a lot of data in our company. We were able to look and see, where's the customer leaning in? What are they looking at? And we saw a couple of things. One, we have this amazing outerwear collection. We've been known for it for a long time. The customer wanted that outerwear. And so we started to lean into offers around that outerwear that started carts. And once we get a cart started, we can really begin to build that order value. And that helped us through the month of December. And in January, we built on that by launching swim early. The customer had been telling us that they wanted swim, possibly as a year-round resource. And we lent into it, started our resort season early, and we saw good numbers come from that. So we went from a pretty rocky start to a really good finish.
Well, Andrew, it's Julie here. I got to tell you, I'm a big beach towel fan of Land's End stuff. I have a lot, like my kids' camps, they're fully outfitted with the Land's End towels and some swimwear as well. So I'm among the ranks of those folks. I am curious what kind of discounting you have had to employ, right? Because that has been something that kind of went away during the pandemic, or at least was a lot less, and then has come back with force to many retailers.
We started to personalize our discounting. So we thought we put the customer first. I know every retailer says that, but we actually looked in and we looked at the behavioral cohorts of our customers. We have a really strong engine that's able to price accurately against them and tailor an offer to them. So if you get an email from us, we have an AI-driven system that looks at the customer, understands their buying practices, and really tailors an offer that's specific to them. And we get way more engagement than that. And one of our wins is, we have conversion that can run 2-3x times any of our competitors. And so we're able to flex that muscle up and down. And that's really how we set about it. So this was not a blunt instrument approach. This was really, really considered and thoughtful about how we got ahead of that inventory and got ourselves to the end of the year looking fresh.
Andrew, my closet is swimming in technical fabrics right now. Where has Land's End adjusted its own makeup of inventory, the different types of fabrics that are kind of woven into the strategy moving forward as you're going after that core consortium or consumer that is continuing to engage with the brand?
It's a great question. We have a long heritage. We're a 60-year-old company, and we've always invested in technical fabrics and thinking about our customers. So I'll take swim. It's near and dear to my heart. The amount of innovation that we do around swim is astonishing, and I actually think we can talk about it more. So I look at, from rash guards to tummy tucks to, strategies for holding you in how you want to look. We've really thought about that. We're going to spend less time thinking about the athletic world, and we're going to spend more time, solving the issues that come up in customers' lives and making them feel great about the product they wear from us. And I just spent time with my merchant and design teams. I wanted a little inspiration before I came on the call, and they were showing me some of the innovation for spring. And what we're starting to do is we're going to flow some of that technical innovation that we've had in swim for quite a long time. We're going to flow that into the rest of our product assortment, and we think that can really drive some of our key categories.
Andrew, how are you guys thinking about store footprint right now? I saw that you saw a drop in your store, company-operated stores comps sales, and so I wonder what the plans are in terms of growing or shrinking that footprint.
Yeah, we have 30 stores. So, I mean, it's not going to set the world on fire in terms of where the size of it is right now. Even though I've come from a store background, I was at several retailers that had a lot of stores. I tend to look at it on an ROIC basis, and right now I see opportunities ahead of stores. We are this digitally native company, sort of a unicorn in there, and that we're scalable, and profitable with our two digital businesses. And I think it's more about putting energy into those and having any activities around that be flywheels that spin customers into that. And I don't know if stores necessarily fit within that, at least for the foreseeable future. And for the foreseeable future, that's 6 to 9 months for me at the moment.
When you look at the mix, the inventory mix, I mean, we continue to hear from retailers what they would deem successful based on the amount of that inventory that they're selling at full price. What's a good figure that you think about at Land's End for that?
Yeah, we don't give that figure out, but as close to 100% as we possibly can. A lot of our mix is actually basics and seasonal basics, and they're in stocks forever. I know you see a lot of it in your closets, and so we lean into those, and we don't need to discount those. So where we ran into trouble was where we get pockets of overhanging inventory. We talked about sleep earlier. We also had some issues with kids coming through last year. We see it in pockets and we take care of those, and it tends to be more on the fashion side of things. So again, it's very specific to the customer because we let that guide us and what we think the customer is going to want at what price.
Andrew, thanks so much for being here today. Really interesting conversation. Andrew McLean, Land's End CEO. Thanks.
Thank you, guys.
Coming up, we'll check the markets as we inch closer to the afternoon trading session. Wait a minute. Look, green.
Ooh.
Stocks are up. We'll be right back.
Must have been the bagpipes.
We've got some big interviews on tap for Yahoo Finance today. Next hour, we'll continue our coverage of the fallout from Silicon Valley Bank's collapse. An expert will join Rochelle Akufo to discuss the government's handling of the banking crisis as well as risk in the financial system.
That's right. And even later in the day, Yahoo Finance's Dave Briggs and Shauna Smith discuss Kellogg's. The company is out with the new names of what will be two separate publicly traded companies once it completes its spinoff of its North America cereal business.
Have you seen the names, by the way?
No, I haven't.
I think one of them is Kellanova. I have to look it up.
Kellanova?
Yeah. Yahoo Finance's executive editor Brian Sazzi sat down to discuss with Kellogg's CEO, and so obviously he'll know the name. We'll have that in the 3 to 5 p.m. hours. Stay tuned for that. And meanwhile, crypto exchange Coinbase noting financial ties to Signature Bank. We'll discuss the banking system's ties to crypto with the Coinbase head of public policy. That's coming up later today.
All right, so Vernova walked so that Kellanova could run.
I guess so. All right, Michelle Kuva's got you for the next hour of trading. Stocks are up.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Acutho. Here's a look at what I'm watching this morning. More twists and turns in the banking sector today. Credit Suisse shares surging the most on record. That's after getting that $54 billion lifeline loan from the Swiss Central Bank. The easing of nerves boosting European stocks. But where does the bank go from here? And what does that mean for the rest of the sector? We'll break it down. Plus, the drama heats up for TikTok. The US reportedly telling TikTok owners in China to sell their shares or risk a ban. We'll tell you why other social media stocks are rallying on the news and how you should play the move for your portfolio. And the rankings are in for the best and worst airports. No surprise here, US airports are on the bottom of the list. We'll tell you exactly how far down the list the US landed and why. But first, I check on markets 90 minutes into the trading day. Quite the reversal here after the lows that we saw to open the start of the session. We see all three in positive territory, lifted by some of the positivity we've seen in regional banks. You see the Dow, they're up about 58 points on the day, just about 0.2%. The S&P also seeing gains 0.6% there. And the tech-heavy NASDAQ, they're up more than 100 points on the day, up almost 1%. Let's also take a look on the Treasury market. We know that when we see those flights to safety, we tend to see some of these yields go down. Continuing to go down today, especially in the short-term yields. The 5-year down more than 3% on the day, the 10-year down about 3.33%, and those longer-term 30-year yields just down slightly, though, about 0.1 points there, about 2.6%. Well, U.S. Treasury Secretary Janet Yellen faces Congress today with comments on the nation's banking system, of course, in wake of the 3 U.S. bank failures. Yahoo Finance's Jennifer Schonberger is here with the latest. Hey, Jennifer.
Good morning, Rochelle. We're about an hour underway into Treasury Secretary's testimony before the Senate Finance Committee this morning. She has assured lawmakers that the U.S. financial system remains on solid footing and offered a bit of insight into what she thinks may be behind the failure of Silicon Valley Bank, including a run on deposits and a liquidity crunch. Take a listen.
Well, there was a liquidity risk in this situation. There will be a careful look at what happened in the bank and what initiated this problem, but clearly the downfall of the bank, the reason it had to be closed was that it couldn't meet depositors' withdrawal requests.
Because their capital was losing value and they were not able to access their capital, and I attribute that to the interest rate hikes that we are seeing in the face of the inflation. Am I wrong in that?
Well, my understanding is that the bank, to meet liquidity needs, had to sell assets that it expected to hold to maturity. And given the interest rate increases that have occurred since those assets, including treasuries and government-backed mortgage-backed securities, they had lost market value.
Now, this is supposed to be a hearing on President Biden's proposed budget, and with that, ranking member of the Senate Finance Committee, Mike Crapo, asked whether the president could commit to negotiating with Republicans on spending cuts and that the debt ceiling must involve fiscal restraint. Yellen responded that the president is prepared to discuss spending cuts with Republicans, but that cannot be a condition for raising the debt ceiling and jeopardizing the full faith and credit of the United States. Now, when asked by chairman of the committee, Ron Wyden, whether prioritization of debt is even technically possible, Yellen said she couldn't commit to the feasibility of that, and of course that prioritization of the debt would be default by a different name. I will have more headlines for this as I get them. Rochelle?
All right, thanks for getting us up to speed. Jennifer Schonberger there reporting. Well, as uncertainty grows surrounding the economic impact from the bank sector turmoil, concerns over recessions coming roar back into the spotlight. And here with the latest pulse on the recession expectations is Yahoo Finance's own Jared Blickery. Hey, Jared.
Hi there. Well, I thought I'd take a deep dive into some of these analyst notes that are coming out and pick 2 of the top ones, Goldman Sachs, JP Morgan. And on Goldman Sachs, this comes from their economic research team, Jan Hatzius & And by the way, Brian Sazi is writing this up today. You can read it on the Yahoo Finance homepage. Anyway, Sazi is saying the investment bank, this is Jan Hatzius, now sees a 35% chance of recession in the U.S. in the next 12 months. Now, that's up from 25% previously. And also, only yesterday, Hatzius cut his 2023 GDP forecast by 0.3 percentage points to 1.2%. Now, it's important to point out that in all the economic melee that we've seen happen, or I should say markets melee, it takes a while for that to develop into the economy. And we're not seeing recession risks right now, in other words, in the current quarter, because the economy is still strong. And that's basically what Goldman is saying here. Hatzius thinks that while the banking crisis is a concern, it will not trigger a rate cut from the Federal Reserve. In turn, a recession may unfold as lending standards are tightened and consumers pull back. And here's a key quote from Jan Hatzius. When financial market participants see a higher probability of recession, they are more likely to expect the FOMC to cut the federal fund rate to stimulate the economy. That's what normally happens. The FOMC, the Federal Reserve, and Jay Powell, they respond by cutting rates when they see problems in the economy. Some market participants also expect the FOMC to cut the funds rate down the road in response to falling inflation. However, we are skeptical that it will, and I think that says a lot. Are we not going to get falling inflation? Is the Fed not going to necessarily respond to that because there are other mitigating factors? We'll have to see. Now, the second note comes from JP Morgan. This is their global markets strategy, and they're saying U.S. and global growth, they look firm, but risks are rising as central banks are talking tough. There is a tension between the health and resilience of the global private sector and the shift in the underlying inflation process. Now, this creates pressures which will likely require an early end to the expansion. So early end to the expansions, well, that means recession. Timing the transition from resilience to contraction, which means recession, not easy, but our bias is for this dynamic to take hold later this year at the earliest. Central banks are a key driver of this transition. So later in this year is the earliest they're expecting this recession. Goldman was saying not this year either. After hiking rapidly last year, this has to do with their central banks. We have anticipated a tapering to more modest hikes this quarter as they search for a terminal rate that disinflates without ending the expansion. So they don't think the Fed is done expanding or is done hiking rates yet, much less cutting. They're not even talking about pausing here. So this would be a more hawkish tone that we're seeing from JP Morgan. Also wanted Brian Sozzi noting to me, analysts at Cantor Fitzgerald noted Wednesday that the spread between the Fed's funds rate and the 2-year, that's a 2-year Treasury rate, had hit 95 basis points. That level was reached before 3 out of the last 4 recessions. So we've had an inverted yield curve going back, I don't know, to the middle of last year in the 2s, 10s. Now we're seeing the shorter end of the curve invert too. So some very powerful warning signs on the horizon here.
Indeed, they seem to be increasing every day. A big thank you there, Jared Blickery, there for us. All right, let's dive into all the latest turmoil on the banks and what's next for markets with Sonali Peer, PIMCO Managing Director and Portfolio Manager. Good to see you here, Sonali. We're seeing a different story for markets today from some of the doldrums that we saw yesterday, this fear about contagion from the banking, what was thought to be some systemic risk in banks. But here you see reports from the Wall Street Journal that JP Morgan, Morgan Stanley and others could be in talks to bolster First Republic, that giving a bit of confidence. Do you think the market action now is better reflecting the reality than some of the fear of the systemic risks that we were seeing yesterday?
So the banking sector is very critical to the broader economy, and that is part, of why the focus has been so heavy. Clearly, the Fed, the FDIC, the Swiss National Bank are doing what they can to ensure more confidence from those who are either have their deposits there, are borrowers for these banks, or shareholders. While, we think that it's going to take some time for this to work its way through the system, but certainly, there's some efforts, and that's kind of why we're seeing amidst a lot of volatility and likely more volatility to come, but today, a turn in stocks.
So how long do you think we're going to keep seeing sort of the volatility or repercussions from what we've seen from SVB's fallout and Credit Suisse as well?
Yeah, it can take months to work through the system because clearly, when banks are in this type of situation, there's a potential for contraction in terms of, lending, and that can lead to tightening financial conditions. So it can take some time, and certainly I think this volatility will be with us for short term at a minimum.
And we're getting some recession projections, as Jared was just mentioning there. How do you think this latest fallout, how do you think that affects the path that we get to recession and perhaps the severity of the recession as well?
Absolutely. So, from even as we look at it from a monetary policy perspective, it's difficult, right? Because they're trying to target inflation, but they have to consider the tightening financial conditions. And that's where it becomes more difficult to predict. But, from our perspective, a recession does seem more likely than not. And these types, the financial conditions tightening really kind of helps bring it forward. But still, we equally do not think that, a recession is likely this quarter, but certainly it's on our radar as concerns are increasing.
And we did see that the ECB, the European Central Bank, still staying the course, raising their interest rate 50 basis points there. What do you think of that move? Obviously, some of these central banks have been trying to move in concert, but this is sort of uncharted territory at the moment.
Yeah, it almost seems like they had this plan, and they went with it, given that but they did highlight that they are continuing to monitor financial conditions and that they will be data dependent. And so, that kind of, while they went with the 50 bip rate hike, which may seem a bit hawkish, certainly, however, I think they've built in the optionality in coming months to be data dependent and as well as watch, if there's further market deterioration.
And a lot of people wondering where they should put their money. We've seen this rush, especially into short-term bonds. Where are you putting your money to work as this continues to play out over the next couple of months?
Yeah, I mean, while the concerns are mounting, we think fixed income does look attractive here. You have a decent level of yield and income and some downside protection relative to, say, equities. So amidst all this volatility, we still think fixed income looks attractive.
All right, well, I do thank you for joining me this morning. Sonali Peer there, PIMCO Managing Director and Portfolio Manager. Thank you for your time this morning. Right, well, Warren Buffett's Berkshire Hathaway purchased more Occidental Petroleum shares as it boosted its stake in the oil company to about 23.1%. Earlier this month, filings revealed that Berkshire Hathaway had resumed its purchases of Occidental Petroleum, and that happened after a 5-month hiatus. Shares getting a bit of a lift this morning, up about 1.5%. They're about 1.6%. All right, coming up, we're joined by the Oxford chief global economist for more on the bank fallout and what it all means for the financial sector. Stay tuned. Industry leaders and innovators from a myriad of sectors are gathered in Austin, Texas for South by Southwest, the music and tech festival at the intersection of key industries such as technology, energy, and of course startups. Amid discussions of the growing real estate market, one question keeps coming up for many attendees. Why is real estate so expensive? Yahoo Finance's Ali Garfinkel attended several housing panels to bring you the biggest takeaways. So Ali, what did you find?
Hi, Rochelle. Yeah, as I was attending all these housing panels, I think I expected a bunch of different themes to emerge. But one question just kept coming up, as you said, housing costs, housing costs, housing costs. Why is housing so expensive? And there were sort of three reasons that I think everybody sort of came back with. The first was not enough inventory. That's something we've talked about a lot on this show, but it was really hitting home for me at South by Southwest. It is in part an Economics 101 problem. There simply aren't enough houses on the market to meet the demand that's out there right now. According to the National Association of Realtors, the supply for homes in the U.S. that are for sale reached a record low in 2022. Now, that number has spiked up slightly since then, but still low labor shortage, rising material costs, rising interest rates. It has contributed to incredibly low supply. The second one that came up was actually a surprise to me. Government codes and regulations are causing a lot of problems when it comes to not only making homes riskier to build, but harder to afford. For example, the regulations imposed by all levels of government on new homes account for $94,000 or 23.8% of the average current sales price in the United States. 94K is being added by government codes and regulations. And of course, anything regulatory is going to be incredibly difficult to unwind. So of all the problems, I think, Rochelle, that we heard at South by Southwest when it comes to housing prices, that was the one I think that people were, frankly, the most stumped by. And of course, the last one that came up was something that has come up on the show many, many times, economic uncertainty. Now, how does economic uncertainty affect housing? Well, there's a lot of questions that home builders have, for example. What will happen with interest rates? Will demand hold up if interest rates keep going up, as mortgage rates keep going up? And are we plunging into a recession? That makes it harder to want to build. It also makes housing less affordable because there are fewer houses on the market. So that said, I will say there is some good news here. This month was actually the third straight monthly increase in builder sentiment levels. So hopefully builders in the market could be due for a lift soon.
And something at the other end of the spectrum, not such great news. Data from Princeton University's eviction lab found that evictions are back to pre-pandemic levels in many U.S. cities. Since March of 2020, U.S. landlords have evicted over 2 million tenants. So with many COVID-era moratoriums ending then, what's the outlook for new supply and more new homes expected to really bring some of these costs down?
Yeah, Rochelle, there is definitely a little bit of optimism. We're definitely in a better place than 2022. That's something I heard over and over and over again. That said, builder confidence being up, good news, right? However, this eviction data could be underselling the scale of this problem. I think it's important to say that, even if more houses enter the market, there's actually a lot we don't know about these evictions despite this data. For instance, the data itself is already jarring, right? Take Minneapolis, St. Paul, right, where over the last 4 weeks, an average of almost 300 evictions a week are being filed. Compare that to COVID eviction moratoriums, that time when those were in effect, that number was 20 evictions a week. So 20 per week, now 300 per week. I think in the end, there's a lot we don't know about this problem, so it's hard to say how much supply will really affect what does and doesn't happen. That said, why don't we know more about this problem was, of course, my first thought as I was researching this. And as it turns out, Princeton's eviction lab is just about the closest thing we have to a national eviction database. So the truth is there are so many places in this country where those numbers could be even higher, and we simply might not know how to address the problem because we don't have the data. But hopefully the more housing supply will eventually help some of those people out.
Well, I know you'll be keeping an eye on that data for us. Yahoo Finance's Ali Garfinkel, thanks so much. All right, checking in on the markets here, sponsored by Tasty Trade. As you can still see here, all green across the board here, continuing with the buying action. The Dow here now up more than about 1/3%. They're up about 95 points. S&P also up about 0.8% there, up about 32 points. Tech-heavy NASDAQ there, the strongest gainer, up about 1/3%. Again, driven by the movement that we've seen with some of these regional banks gaining traction, as First Republic might be getting a bit of help there from some major banks, and also some Credit Suisse relief with that injection of cash there from the Swiss Central Bank. All right, coming up, why stocks are in the green this afternoon. We're joined by the Oxford Chief Global Economist after the break to discuss. Stay with us.
The Federal Deposit Insurance Corporation, or FDIC.
FDIC.
The FDIC.
The FDIC.
The FDIC, the Federal Deposit Insurance Corporation, was established during the Great Depression to restore our faith and our trust in America's banking system. But what does it do?
Its job is to protect your deposits that you put in regulated banks. Regulated banks will have a sign that says FDIC insured, and it will also say what the deposit limit is. The current cap is $250,000. The FDIC has a perfect record of protecting insured deposits. Not only that, but the policy has been, we did it every single time during the Great Financial Crisis. You'll have access to your insured deposits within 1 business day if your bank fails. For those who have more than $250,000, though, they should be aware that if the bank fails, they may not be protected.
So how do banks turn a profit? Well, they keep a portion of the money you deposit as cash or reserves to handle those day-to-day withdrawals. But the majority of your money is invested, and it's invested in mortgages, car loans, treasury bonds, the list goes on. And they make their money from the interest that's earned on those investments.
But sometimes banks do stupid things with your deposits. Yeah, doesn't happen very often, but sometimes it does. And that's why the FDIC is there. If the bank does stupid things with your deposits and loses too much money and becomes insolvent, the FDIC is going to swoop in and make sure that your insured deposits are whole.
Some big banks may be lending a hand to First Republic Bank. JP Morgan and Morgan Stanley are reportedly considering a deal that would include a large capital infusion into the bank. That's according to the Wall Street Journal. Well, joining us now is Ines McPhee, Oxford Economics Chief Global Economist and Managing Director of Macroeconomic and Investor Services. Great to have you on the show here. Obviously, a lot to untangle here. So we're going to first start with what we're seeing with some of the growth, well, at least some of the improvement that we've seen with regional bank stocks on this report from the Wall Street Journal. So how much does this speak to this not being a systemic issue then, once you sort of see these isolated issues that we saw with SVB and Signature Bank?
Well, certainly, I think the thing is that so far what we're seeing is a number of different idiosyncratic problems, and that's created what I would describe as a bit of a panic at the moment. Regulators, policymakers in general are now responding to that, offering liquidity, helping to calm the market a bit, and so far you've seen a bit of a relief rally. Clearly, there's still a lot of tricky days to navigate ahead, not least the big monetary policy decisions that we've got coming up in the coming days.
So what do we think is the best and worst case scenario when you look at that fallout and then add to it what we're seeing across with Credit Suisse as well?
Well, I think the best case scenario is really one in which central banks step in and provide a lot of liquidity and really make clear that they're going to backstop all the liquidity that's required, both for the big institutions, but also for the smaller institutions, which of course are really important, particularly in the US for lending to all sorts of sectors, but particularly commercial property. And then I think that would help to just really bolster confidence and allow financial conditions to kind of ease somewhat from where they are today. The worst case scenario is really one in which you don't see an overwhelming response from policymakers, one in which these concerns persist and rumble on, financial conditions remain tight, and that feeds into lending standards. And then ultimately that translates into a lack of supply of credit for the economy, and it pushes us into a recession.
So Ines, I want to now focus on Credit Suisse. They got that $54 billion emergency liquidity from the Swiss Central Bank, gives them some breathing room, but doesn't take away from some of the underlying problems the bank already had to get it into this position. So is that the right move? Is this a situation where they had no choice but to act?
I don't know if they didn't have a choice, but I think it's certainly positive that they've done so. It certainly allows some breathing room, like you say. I think the issues at Credit Suisse, which are well known about, are very different from those of SVB or most other banks. It's really about the business model and how they react and restructure the business and move their way into better profitability. I think it's also fair to say that from what we know, the Credit Suisse balance sheet looks very strong, including with a lot of liquidity. So it's a good vote of confidence from policymakers, which hopefully gives them that breathing room, as you say, to help try and tackle some of the longer term issues, which really, they're not the sort of things that you can just make an announcement and then it's going to divert market attention. Really, we're talking about big structural strategic changes to the way that bank operates.
And in this, we've had a lot of people make comparisons to the 2008 financial crisis. Also, even Elon Musk tweeting about comparisons to the 1929 bank run as well. But I want to ask you about this tweet from Nouriel Rabini. Granted, he's known as Dr. Doom, so you knew it was going to be something on the more negative side. But he said the Credit Suisse crisis is a Lehman moment for the European and global markets, too big to fail and too big to be saved. It's not even clear what their various unrealized losses on securities and other assets are. Is Credit Suisse too big to fail and too big to save? And is it even fair to call this a Lehman moment?
I'm not sure it is, to be honest. I think clearly 2008 was a very, very different set of events. We had a big deterioration in the real economy. We had losses that people weren't clear about how they were, where they were distributed around the banking sector, who was exposed to who, those sorts of things. Now we are really in a world where we've got a lot more financial stability tools. We really spent the last 15 years thinking about how banks can fail, particularly big ones, how to resolve them. And, it's just not, I don't think it's really a fair comparison at all, really. I think we'll ultimately see how financial conditions play out in the coming months, how the central banks will react to them. But fundamentally, when you think about the fundamentals of the real economy, there isn't a sign that there's a huge amount of leverage around. There isn't a sign of huge excess imbalances. So whilst we think that the US, for example, will head into recession in the second half of the year, it will be a pretty mild one. And when you think about what that implies for bank losses, it's a completely different scenario from that of 2008-9.
So then as we take that look, take that view, obviously what we're seeing now with the banks, seeing that it's not systemic, I mean, US Treasury is still keeping an eye on this. What are your expectations then for the rest of the year as this, sort of the reverberations continue to play out?
Well, I think the first thing to say is that we've already seen tightening in financial conditions come through, and that played through really from the tightening in monetary policies that we saw already last year. So we know monetary policy acts with the lag. We know that that's taken a while to get into financial conditions. We're starting to see it in terms of lending to the real economy, and that's particularly true in the Eurozone, for example. If this episode rumbles on, it really means that we're going to see more and more pressure on the supply of credit to the real economy, potentially also demand as well. And then that will start to have an impact on real economy, we think, towards the end of 2023, certainly the second half. So to the extent that this episode really means a doubling down in those tightening of credit conditions, then you can expect a worse outcome in the real economy. But for now, we're certainly sticking to our view that we'll see a relatively mild recession in the US. We'll see Europe and the UK largely avoid recession.
We do appreciate you joining us for your insights. Ines McPhee there, thank you for your time on Yahoo Finance today. All right, coming up, fears of a banking crisis put U.S. markets on high alert, but a cool down may be coming soon. More next.
Unrealized losses.
The unrealized losses.
We've been hearing the term unrealized losses a lot lately, but what does that mean? It's basically losses that are on paper. If you have an asset on your balance sheet as a company, an institution, it fluctuates in value, right? Because it's something that is pegged to the market. If that asset has gone down in price on paper, that is on your balance sheet, you have recognized a loss, an unrealized loss. That loss only becomes realized when you have to sell that asset if the price has gone down. One maybe easier way to think about it is to think about a real asset that might be on your personal balance sheet, like a house, for example. Let's say that you buy a house at $300,000. You live in that house for a while, but then something happens in the housing market. The price of the house goes down a little bit, say to $250,000. That means it's an unrealized loss. You haven't sold the house, you still live in the house. If something happens and you're then forced to sell that house, you take a realized loss. That unrealized loss becomes realized because you've made the sale. But let's say you live in that house for a while longer and the price goes up. Well, then you don't have an unrealized loss anymore. You actually have a gain. So that's how we can think about these various issues. These losses don't become realized unless
like some recent companies in the news, you are forced to sell for whatever reason.
Silicon Valley and Signature Bank's collapses triggered fearful flashbacks to 2008, but our next guest says the problems plaguing SVB and Signature are unique, and when paired with the government's swift response, better days could be fast approaching. Joining me now is Seth Berensweig, managing partner at Berensweig Leonard. Good to have you back on the show, Seth. So we saw this panic when there was this fear about this contagion or whether or not it was systemic. You say that this is overblown. Walk us through that.
Well, I think that while there are certainly risks in the system, there's a lot of things that are being overblown, and there is a misperception of what the real risks are. So just to clear the table a bit, there have been fundamental misconceptions about how the FDIC and its insurance program works. I had the pleasure of actually working at the FDIC for several years. In a prior chapter of my professional career, I can tell you they're tremendous people that can move mountains pretty quickly, and they're actually going to be selling off these bulk of deposits within the next couple of days, which is pretty incredible. But when we hear about references to bailouts or national takeovers, that's not what's happening at all. We have not only a privately funded insurance program, but we have a very elegant system in place now that was created in a very novel way over the weekend, where we now have this lending facility that's also backstopped by the United States Treasury. That has really instilled confidence in the markets here in the United States, and I do believe that it is fundamentally protective and safe to say that people's deposits are secure. Now, of course, we had another black swan event fall out of the sky with Credit Suisse, although now they have a lending facility too. I don't believe that there are the risks that are on the table that are being discussed. There may be a few canaries left in the coal mine, in that there are still portfolios of larger banks that still have these long-term treasury bills that are yielding in the low figures. The difference in the uniqueness of the crisis in California over the last couple of days is that their portfolio of those instruments is at about 50%. The typical bank in the United States have these short-term and long-term treasuries that are closer to about 15%. So the bottom line is that I believe that we are safe right now, although it sure would be nice to stop seeing these black swans fall out of the sky.
It certainly didn't help with Credit Suisse coming right after that, although Credit Suisse has its own set of problems that was already leading up to this. You mentioned that a few other banks could be in a similar position. Are there any in particular that stand out to you?
Well, First Republic certainly seems to be under a lot of pressure, and it's very difficult to say. JP Morgan has certainly swooped in, and they've come to the rescue. So in addition to the new lending window provided by the Fed, JP Morgan has come in to help them. I think the biggest problem in terms of what's happening right now is that we've learned on a week-to-week, if not even at a day-to-day basis, that we just don't know what we don't know. But the good news is that we really do have a very agile and creative joint task force. What's happening right now is we're living in a historic moment in terms of the regulatory environment that is surrounding the banks. We really have a full court press because we have the FDIC, we have the Treasury, we have the Fed that are really creating a joint task force to go in and really back up these deposits. So in the short term, we have the lending window, which decreases the risk. And if there has to be a sale of these bonds, they can be done in a non-distressed manner. They can be submitted as collateral security at par, which means that the pressure is taken off. They don't have to run a fire sale, and then we're not going to have all of these liquidity runs. At the end of the day, what we really have right now is more of a crisis of confidence. The biggest risk that I see out there right now is that the ECB just raised rates. We're going to have to see what Jay Powell tells us next week. And the more that you have an interest rate spread, that's going to affect these other instruments that the traditional banks are still holding roughly 15% in their portfolio. We're not out of the woods yet, but the American depositor, I believe, on balance, should be relatively secure that their money in the American banking system is safe.
So, Seth, while we do still have this, as you mentioned, this sort of crisis of confidence more than anything else, especially with the regional banks, how long do you expect that to really keep reverberating? And could we perhaps see some M&A action in this space?
Well, I think you've identified an important point. That's something that we're going to have to really keep a very close eye on in the next couple of weeks, because one of the risks and the biggest danger in a shortfall of confidence in the American banking system is that you'll see a sweep of deposits that will go from the small regional banks up to the big banks. And what that would mean is an undue concentration for bigger banks that continue to be ever too big to fail. And that means that a larger concentration of more services by fewer banks means higher costs ultimately for the consumer, and that's not good for the system. So there is a short-term danger of a transition away from regional banking, but I think that the FDIC and the Treasury have done an excellent job of instilling confidence. So although that is a short-term risk, I think that has been significantly moderated. Keep an eye on what happens over the next couple of days in terms of the interest rate environment and what Jay Powell has to say. But for now, especially in light of the new facility and the lending window that's been provided to Credit Suisse in Europe, and of course they have their own historic problems. For now, as long as we don't get flooded by black swans, it looks like we will hopefully have pretty clear sailing ahead.
Well, here's hoping so. Always great to get your insights. Steph Behrens-Zweig there, managing partner at Behrens-Zweig Leonard. Thank you so much for joining me this morning. All right, stay with us on Yahoo Finance. We have much more coming up after this break.
We all know the FDIC protects your bank deposits up to $250,000. But what if you have your money in a brokerage account or even a credit union? We asked Bankrate.com Chief Financial Analyst Greg McBride.
If you have money in a brokerage account, this is something different from the FDIC insurance you have with your bank. Brokerages, if they belong to the Securities Investor Protection Corporation, they have this SIPC insurance, and that'll protect you up to $500,000 in losses in the event that the brokerage firm goes out of business. Now, that just protects the fact that your securities won't be part of that liquidation. It does not protect you against investment losses, and that's a key distinction. The value of your account is going to fluctuate. SIPC insurance doesn't protect you against that. If you have money with a credit union, this is likely federally insured as well. The National Credit Union Share Insurance Fund provides, similar to the FDIC, $250,000 worth of coverage to credit unions. Before you put your money in a credit union, just make sure that they are protected by that National Credit Union Share Insurance Fund. Just like with a bank, you want to make sure you're putting your money in a place that's federally insured. But as long as that's the case, you are protected up to $250,000, just as you would by the FDIC at a bank.
Microsoft announced that it's bringing its generative AI capabilities to its most important software, Office 365. Now, the new feature will be called Microsoft 365 Copilot, using similar tech behind its AI-powered Bing software. Yahoo Finance's Dan Howley is here with the latest. Dan, always a move here every day, it seems like, in generative AI.
That's right, Rochelle. This is basically a kind of tit-for-tat game that we're seeing being played. Just as Microsoft announced its OpenAI-powered Bing in early February, Google announced their Bard AI chatbot just a day before that. And now, just 2 days before Microsoft unveils its own Microsoft 365 Copilot AI, Google did the exact same thing with its own workspaces apps like Mail, Docs, things like that, having an AI capability. But here we're talking about Microsoft 365 Copilot. And basically, you can think about it as almost a ChatGPT for Word, PowerPoint, Outlook, Excel, and Teams. Microsoft is saying that this isn't necessarily ChatGPT in its entirety. It's pieces of ChatGPT, other large language model capabilities as well. And so essentially what you're looking at is the ability to type in prompts and then have, for instance, Word put together a quick document for you that you can then go in and edit. And Microsoft is very careful to say, look, sometimes it's going to put together the wrong kind of document for you, but that's why we're allowing you to edit it. And even the wrong stuff can be helpful to a degree. But if you're in a crunch, we'll see if that's how you feel. On the PowerPoint side, this would have helped me enormously in high school, middle school, and college. It can put together a PowerPoint presentation for you based on a few prompts that you can then judge on your own. Excel, it can take some data and then turn it into visuals for you, which is pretty impressive. And then on the Teams side of things, Microsoft is saying that it will be able to follow along with meetings and then pull out the important parts of those meetings for you so that you're then able to get action plans moving forward. So really some impressive tech here. I think this is where generative AI is really going to shine. Well, it's not necessarily going to replace white-collar workers or workers in general at this point. It's still, very basic stuff that we're looking at here. This isn't going to, your computer's not going to stand up and start running across your desk anytime soon, I hope. But this is still very impressive technology, and it goes to show you how fast Microsoft wants to iterate on this to stay ahead of the competition. They said this will be available in the coming months. Google, meanwhile, they're testing that, their own product with some trusted testers. So we'll see which one really hits the market first. But, this really is the new platform war is AI.
And certainly would save at least some college students some all-nighters there with having that Copilot on hand. Also want to take a look at Stripe, which has slashed its valuation. What's happening there?
Yeah, their valuation is down. They actually brought it down to about $50 billion on a $6.5 billion funding round. They say that this is just cash that they wanted to raise to essentially pay tax bills. So it's not something they needed to actually continue to operate the company. But you saw that drop there from its previous valuation. And so, this kind of just shows you how difficult the market is right now for companies like this, where they're trying to raise capital and they're going to run into some roadblocks and cutting this valuation by nearly half. I think that's really something that we're going to have to talk about going forward with some of these private companies as they continue to raise funds. And it can be looked at as a positive and negative. The fact that they were able to raise as much for themselves at this point, and also the fact that they just didn't necessarily, this isn't something they needed to continue to operate the company itself. It's part of a tax bill. So I think that's really something that's worth noting here, but it's definitely something we're going to have to be watching going forward when we're looking at companies trying to raise funding in the future.
Indeed. Dan Howley, thank you so much for that update. Well, the U.S. is hardening its stance on TikTok. The Biden administration is reportedly demanding that its Chinese owners sell their stakes in the business or could face a ban in the US. That's according to the Wall Street Journal. For more on this, let's bring in Bernstein Internet Equity Research Analyst Mark Shmulik. Thank you so much for joining me this morning, Mark. So obviously a lot going on here with TikTok. I do want to first start with this push that's been made by CFIUS, the Committee on Foreign Investment in the US, ruling that the Chinese owners of TikTok should sell their stakes in the company or face this potential ban. What is your take on that strategy? Obviously, this is being used as a national security angle as a reason to ban TikTok.
Yes, thanks for having me. I'd say my first view on it is it's probably a high-stakes game of chicken. And what I mean by that is if we rewind a little bit to when the Trump administration, attempted to get kind of TikTok spun off or sold off, the Chinese government effectively put in a new law banning the sale of IP. And so I believe CFIUS knows this, the administration knows this. And so effectively putting this ultimatum out there that's been reported, knowing full well that China can't simply divest TikTok. And so I think we're entering into this very high stakes game of chicken around the application, where, the path to pursue just an outright ban as a starting point is likely off the table, given, that users love it. They love to use it. And so you never want to alienate your voting base. And so I feel like that's how we've ended up at the point where we've ended up.
So what is a realistic path forward here then for TikTok?
I think the most realistic path forward is we just continue as is. I think, we continue to have these discussions and news flow about potential bans, restrictions here and there. I know ByteDance believes strongly in their Project Texas approach, working with Oracle. And so maybe there's some settlement that's reached at some point around security measures, around where data is stored, accessed, and how the algorithm effectively gets deployed. So I always kind of err on the side of path of least resistance as we continue forward, albeit with continued news flow. That seems to be, the way regulation has so far affected many of the internet names. So that would kind of be the default. If that doesn't occur, I'd probably err on the side of a ban being slightly more likely than an actual spin-off. But it's really hard to kind of underwrite either of those scenarios given where we're at.
And you really can't underestimate just how much TikTok really changed the game when it entered the market here. And in the Bernstein note, it says that TikTok ruined the internet. Walk us into some of the mindset behind that commentary.
Yeah, sure. Certainly a little bit, clickbaity as a title, but I think our view is twofold. One is it certainly changed the way we consume the internet, and I think that's evident by the amount of short form video features embedded in pretty much every application, these days. Even Spotify kind of announcing it recently, and so that's kind of changed the format for how we consume internet. We prefer video now. We prefer not to make decisions, so having an app open up where content is immediately pushed to us. But secondly, it also changes the economics of also how we consume content. And so, where we went into in the note is trying to understand how do the economics work from a business model perspective of short form video, because it is more of a broadcast platform. It does lend itself well to more, broad-based advertising campaigns, but you're also watching video rather than simply kind of scrolling through and clicking on things. And so our view is it changes how we consume it, but also the underlying economics of how internet business models monetize.
And even as we talk about the impact, when you look at what Facebook then started to do with some of its content creator funds, with Instagram Reels, what YouTube was doing with Shorts as well, talk about really the stakeholders in this and the biggest beneficiaries if there is going to be a potential ban.
Yeah, we actually have a market to take a look at where TikTok was banned, which is India. And what initially happened when TikTok was banned in India is you saw this kind of rise of effectively TikTok clones, local homegrown TikTok clones. And, while they're still around, much of the behavior shifted towards these larger kind of multinational platforms. YouTube and Shorts is very dominant, in India. Instagram certainly benefited, and Snapchat did as well. So in terms of where the users go, if there was a ban, I think it's kind of, easy enough to draw the reference to India and say, well, likely the remaining incumbents benefit, which is also why you see their stocks react positively to any news flow, tied to a potential ban. I think they've all got very different angles through how they're going about doing it, be it are they going after creators, are they embedding it into the core product versus a separate tab. So there are some of these more tactical things, but I think our kind of house view is that if there was a potential ban, expect to see the local incumbents benefit.
And certainly we'll have to see if the influencers, the active users, and of course the advertisers follow suit as well if they do go elsewhere. Bernstein Internet Equity Research Analyst Mark Schmulek, thank you so much for joining us. All right, coming up, we take flight and check in on the world's best and worst airports of 2023. Stay tuned. Recovery in the travel industry is alive and well as millions return to a travel state of mind. But which airports were crowned the best and worst as you pass through to get to your destination vacation? Well, here with the details is Yahoo Finance's Brad Smith. Brad, I have my own picks, but I'll let you go first.
Well, a lot of people like you might have their own personal preferences, and for anyone planning those summer vacations or any type of getaway for the rest of the year, cranking Lenny Kravitz's Fly Away while they do so, here are a few of the airports that might serve you the best experience, and here's how they ranked. Coming in at number 1 on the list, you had Singapore, Changi. You also had Doha, that ranked number 2. Topping out at number 3 was Tokyo, Hamada, and then additionally you had Seoul and Paris, bringing in the top 5. And one thing that is worth noting here is also some of the top 5 in the U.S. as well that we've been tracking. I was actually able to compile those too. Here's a list of those for you, blown up on full screen for you. Number 1 in the U.S. was Seattle, Tacoma, everyone. Also Houston for both of their airports, coming in at number 2 and number 3, at least in the top 5 of the U.S. airports that made this list. And then number 4 was Cincinnati, North Kentucky, and number 5, San Francisco. Now, for those New Yorkers out there that are wondering, hey, where did JFK come in? Well, it's number 88. It's not doing too hot. Also, here's one of the biggest surprises. LaGuardia, LGA. Call it a comeback, folks. This one jumped a whopping, get this, just about 60 spots. Huge win there, but of course, that's on the back of about $4 billion worth of renovations, Rochelle. And so within all of this, there was another more massive move to the upside, and that was Lyon Airport. Of course, that in Paris, or in France rather, and that one jumped about 80 spots. That had Terminal 1 renovations that took place, was worth about $250 million. Terminal 2 renovations just started, expected to last through about 2024 as well.
Now, I'm a bit biased, but one of my favorite airports is London Heathrow, even though you might have to walk about 10 miles from your gate to actually get to the main airport. Worst airport, though, I still have PTSD from it, is flying through Chicago O'Hare.
Oh, my gosh.
Every time. I still remember someone literally physically scraping the ice off a wing as I was about to take off. I was like, I can't do this. This is too much.
Here's the thing. I've seen entire marketing pitches put together around Chicago O'Hare. Why? Because it was the airport that had the most delays or cancellations. And so for marketers, yeah, it's a dream come true because you're like, all right, I have so much time to get in front of my potential customer sitting at Chicago O'Hare, and more likely a business customer given the number of connections that go through there. But a lot of people just thinking, what makes the best experience at an airport? Well, just being able to get out of the airport should be one of them. But then additionally, how the food stacks up, how you're able to do some shopping perhaps along the way. So all of these things factor into a good experience, and the energy usage, the environmentals of the airport are increasingly being factored into some of these rankings too, Rochelle.
I would say food, a good lounge, maybe some good shopping if you have time. All valuable assets there for an airport. Brad Smith, thank you so much. All right, let's do a final check of the markets as we head into the noon hours. We still see all three in strongly positive territory there, though dialing back a little bit. But the Dow there up about 210 points on the day, 0.6%. The S&P 500 also seeing strong gains, up 1.3%. But look at tech-heavy NASDAQ, up almost 2% on the day, continuing to see that buying action on some of the positivity that we've seen with regional banks, although those regional banks still in mixed territory at the moment. That'll do it for now. I'm Rochelle Akutho, but I will be back at 11 a.m. Eastern. I'll see you then.